Test, test, 1, 2, 3.
Okay. Good morning. I'm calling this meeting of the second day of our board offsite to order at 8:30 a.m. right on time. Don't ever let it be said that I'm not on time occasionally. So let's go ahead and start with, do we pledge allegiance again? Okay, well then, Mr. Santos, would you like to lead us in the Pledge of Allegiance?
All rise. Ready? Begin.
I pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all. Thank you. Linda, do we have any announcements?
Yes. Thank you, Ms. Sanchez. This meeting is being conducted as a virtual and in-person meeting, so we'll do a roll call of the trustees to confirm attendance. Ms. Ginsburg? Here. Mr. Santos?
Here.
Mr. Green?
Present.
Mr. Jones? Mr.
Present.
Jones, okay. Mr. Ru is not here, and Ms. Sanchez.
Here.
And we have Mrs. Gray from the Board of Retirement. Staff participating in the meeting include the following: CIO John Grable, Deputy CIO Jude Perez, CEO Santos Kryman, Chief Counsel Stephen Rice, Deputy CEO Louis Lugo, AEO JJ Popovich, and Interim CFO Ted Granger. Investment staff include James Rice, Dale Johnson, John Kim, Christopher Wagner, Didi Acevedo, Tara Elijah, Mike Romero, Magdalia Armstrong, Kwa Quinn, Shelley Tilley, Inga Tadevosian, Sanaya Ganoyan, and Catherine Todd. Consultants and presenters include Kristen Jones, Jennifer Young, Mark White of Alborn, and Margaret McKnight, Jose Fernandez, Natalie Walker of Stepstone. Trustees, please use your raise your hand option to be placed in the queue. At this time, we ask all meeting participants to mute their mic until you're ready to speak. And now we may proceed with the agenda.
Thank you. Do we have any requests for AB 2449?
We do not.
All right. Any public comment?
No public comment.
Okay, moving along. We will start with our risk management in private markets panel. And I will invite James Rice and Tara Elijah to come forward and introduce our panel and kick us off.
Try that again. Thank you, Sir Chair Sanchez, trustees. Good morning, everyone. I'm glad to be able to introduce the first session of the day. We have a very rich discussion ahead of us to start this second day of the on-site, off-site. This session will cover risk management in the private markets. On the next slide, it shows the session outline. Right now is the first section, a brief introduction led by me that will cover the basis of LACERA's risk management framework and sets the stage for the broader discussion. Then next, our board consultant, Alborn, will do an overview of their framework for risk management at a high level for private markets. And as a reminder, they consult for our private infrastructure, natural resources, commodities, hedge funds, as well as private credit. And then we will hear from Stepstone, our board consultant for both private equity and private real estate. And they will outline their risk considerations and process behind assessing and monitoring private market risks. Following those overviews, we will transition into a panel discussion with all of the consultants, and it will cover risk factors for private markets, and our PIO, Jim Rice, will moderate that panel. So representing Alborn today, on the next slide, are Kristen Jones, Jennifer Young, and Mark White, and bios are here within. And for Stepstone, Natalie Walker attended yesterday's sessions, but representing Stepstone today, we have Margaret McKnight and Jose Fernandez. We're all very familiar with our consultants. Next slide, please. And thank you so much, Melissa, for driving the slides. The focus of today is the holistic approach that LACERA and our consultants take to assess risk of our privates portfolio. We will discuss the policy, process, tools, and considerations for risk that are more prevalent in these portfolios. So given the strategic asset allocation process that recently kicked off, this discussion should help inform that process. It all starts with and is guided by our investment policy. Within our current policy, there is a risk-based asset allocation with an increase to private markets over the years, which is part of the evolution of the portfolio, which is also a session we'll be having later today. Each private asset class has unique risk and complexities that are not present in public markets, and we expect to be compensated for taking on many of those risks. And we have steadily been increasing our knowledge of risk by investing in sophisticated tools to help us analyze them, and by doing ongoing in-depth analysis of our investment managers as well. Next slide, please. So LACERA's governing documents such as policy, strategic initiatives, our work plan, and our stewardship efforts as well, all set the strong foundation on our risk management approach. And on the bottom of the slide, we pulled out some of the core language on risk that's within our policy, and it speaks to the fact that there's no single metric that conveys risk, and we'll have that holistic approach and aim to minimize any risks that are not to be expected to be rewarded over the long term. Within our policy, investment risks are listed out if you look at the bottom. Macroeconomic and political risks, which Jean from BlackRock discussed yesterday, for example, and operational risks, such as business continuity within crisis and talent management, which we also touched on yesterday and often do. Our consultants will be highlighting these risks and other risks throughout today's session. On the next slide, there is more language from our policy where we get into the risk factors by functional asset category, and we address within policy some of the unique risks that are in each of the different categories. And lastly, the slide I'll cover shows the target allocations from our policy today and looking back 20 years. So it's very interesting. It illustrates the ramp up of private markets during this time. And the target allocation to private markets has more than doubled over this time period. In 2003, 17% of the target allocation was to private real estate and private equity. And today, 44% is targeted for privates. And notably, in recent years, we've diversified into infrastructure, private credit, and diversified hedge funds. And with that increase, private markets risk management is an important focus for us. And without further ado, I will turn the presentation over to Alborn to give their overview. Thank you.
Thank you, Tara, and good morning. Starting with the chart on the left, I would like to walk through our risk framework for private markets, which is primarily centered around 5 pillars and forms the foundation of how we at Alborn identify, monitor, and manage risk. Starting in the middle, one of the key considerations when investing in private markets is liquidity or the lack thereof. This is the key risk that we strive to get compensated for when underwriting a private market fund. Investors often underwrite to a higher return target than they would for a similar public market investment. On average, this is 250 to 300 basis points over a passive benchmark, but differs from one organization to another depending on the portfolio objectives. Unlike in public markets where you can trade in and out of stocks as market factors change or new information is available, there is a low likelihood of changing course once a commitment is made, because while investors can build in opt-out clauses, these are rarely exercised and come with very specific conditions, and secondary sales come with higher transaction costs compared to public markets. So the fund structure, terms, and the manager whom you partner with are extremely important. Also, when allocating capital to a private market fund, investors are exposed to blind pool risk because typically there are no investments in the portfolio at the time of making a commitment. Unlike with a public security, years of historical data is available to analyze the company you're investing in, and you know exactly what you're adding to the portfolio at the time of execution. So as we highlight in the second pillar, asset, because we're investing in a blind pool without proper structure, for example, asset concentration limits that investors can hold a manager to, this could expose the portfolio to concentration risks in certain sectors or geographies. We also have operational and regulatory risk considerations, which investors often view as uncompensated risks and involves getting comfortable with the transparency and governance of the manager and fund that you'll be partnering with. Unlike publicly traded companies, which are regulated and required to file certain disclosures, including quarterly financial statements, for private fund investments, this information is not always readily available, and investors need to compile this data on their own, which involves staying on top of reporting from managers on a quarterly basis and collecting data to address the underlying asset level exposures and also other factors that are important to the organization, like ESG scores, as an example. Given the asymmetry of information, governance is an important factor to consider from a monitoring perspective, and it's common for commingled funds to have a limited partner advisory committee, or LPAC, to keep the manager in check. This ensures that investors are made aware of and approval is sought for any transactions that may result in a conflict or deviates from the outlined strategy, and large investors like yourselves are often invited to participate on these committees. Finally, on the left-hand side, market risks or price volatility. As we've seen in the past 2 years, private market valuations are lagged. So we're less focused on price volatility, but more on underwriting the risk of permanent impairment, or said another way, principal at risk. And there are a number of things that the team does to manage this risk to protect the plan's capital. Next slide, please. Kristen will walk through in more detail how these risks are assessed and managed through the investment due diligence and operational due diligence processes. But before I pass the mic to her, I just wanted to touch on portfolio construction, which is in the top left-hand corner. In my role as a portfolio analyst, I've worked with clients to mitigate some of these risks through portfolio construction. Having the right asset allocation will not only protect against market risks like inflation or other macro factors, but also help avoid concentrations in any one sector, geography, manager, or investment within your private market portfolio. Liquidity is also taken into consideration. For example, does the plan expect to have sufficient liquidity to fund capital calls? And how does that impact your pacing plan? Is there sufficient vintage diversification that provides for a consistent stream of distributions? All of this underscores the importance of the strategic asset allocation study.
I'm going to cover the 3 diligence functions shown here: investment, quantitative, and operational due diligence, and some examples of how we're assessing and mitigating risks within this framework that Jen has outlined for us. But just before continuing to do that, I do want to highlight or perhaps remind folks of how our teams are set up to measure, monitor, and manage risks across cycles. At Allborn, we're a highly integrated and collaborative team, but we're specialists across asset classes around the world, and with an institutional memory that's nearly 3 decades long at this point. Our diligence and our assessment of risk is really rooted in what has caused investments, funds, managers to fail in the past. At the same time, our risk analysis and the areas of focus are always evolving. We're thinking about what could happen and bringing a level of nuance that comes from living on the ground in these markets day in and day out through the ups and the downs. Starting on the top right now, with IDD, or investment due diligence, we tend to focus on risks that are, or at least should be, compensated for, and impairment risk. Again, that's losing money, whether in the short term or the long term. and whether it's a direct loss or an indirect loss in the form of an opportunity cost. You see here on the slide next to IDD, we've highlighted market and asset risk. These are covered in the strategy and investment process sections of every IDD report we write. On the market side, for example, we dig into the market opportunity. Is it the right sector, the right time, the right price? The research capabilities. Does the research team and technology bring an edge in the quantity, the quality, or the speed of research? Sourcing and selection. Has the team demonstrated access to deal flow? Are they able to create deal flow? Have they avoided potential negative selection bias? Is there strategy drift? On the asset side, think deal structures, assessing if they've gone too junior, if covenants or protections are weak. What's the collateral? Capital structure, is the structure over levered? Who else is in the structure? Are they like-minded? That's a particularly heavy focus for us at the moment. Ownership, whether it's a passive or active strategy, what's the ability to get active to protect value? On the flip side, in a growth strategy, how much of that is really reliant on market growth, cycle timing, capital market access, all the way through to exit strategy, ranging from self-liquidating structures to really highly market and cycle dependent exits, thinking about residual value or IPO market risk. You also see organizational risk highlighted by IDD. Here, for example, we dig into key person risk. The loss of a key person is, of course, a risk, but even if it's handled relatively well, it can lead to team turnover and instability at the firm. That has real knock-on effects. Compensation and alignment. Proper alignment is critical to ensuring the right amount of risk is being taken on. Team capabilities, for example, workouts. Both protecting and salvaging value is a key risk management skill set that we look for at managers, and one that we're really heavily focused on in a market where we expect overall defaults to increase and recoveries to decline. But we also zoom out from the day-to-day of the asset management and the team to look at the overall firm and its ownership and stability. How stable is the capital base? Are there allocation considerations? What are the motivations and the strategic goals of the ownership base? This is all really in the pursuit of understanding the risk profile of the offering and also identifying best-in-class managers that offer the best combination of expected exposures and return per unit of risk for the LACERA portfolio. Turning to that bottom right pie wedge, QDD, or what we call quantitative due diligence. Here, we're primarily focused on gathering data and turning that into information and insights. You see here on the slide next to QDD, some examples of risk areas we focus on in the QDD report and the track record and portfolio sections of our IDD reports: asset, concentration, transparency. It's not a mistake. We intentionally put asset twice on here, really to highlight the separate but integrated pieces of the risk management framework at Allborn. The separation allows for some important checks and balances and some independence of analysis, but integration is really what allows us to bring the analysis and the narrative together as advice that LACERA can then make actions based upon. We're monitoring exposures, we're gathering supporting evidence, but we're also seeking out hidden risks. Things that may or may not have surfaced in prior performance figures or in prior conversations with the manager. Are exposures and the return construction profile what we expected and what the manager pitched? Are the returns contractual, driven by appreciation, leverage, GDP? What's the level of development risk, execution risk? Essentially, is the manager doing what they said they would do? And was there more or less risk taken on to generate the returns that we've seen? Answering that simple question is not simple, and it requires both qualitative and quantitative analysis. The trend has been towards increased transparency across most asset classes and across most managers, which is a good thing, of course. But it's easy to get bogged down in the huge volume of data and the noise in that data. The key is really not to just collect the data, but it's to actually make use, an effective use of that data as a risk management tool. That in itself requires tools and oversight, as well as the right structures and an active risk management mentality, even in private markets, which I think we're all excited to talk about in the panel portion as well. And then just lastly on this slide, ODD or operational due diligence. Again, in ODD, we tend to focus on the uncompensated risks. Again, as an investor, you're not compensated for taking on more operational risk, but you want to go into each investment with as much information as possible. So our risk identification process really looks to achieve this, while our feedback process with GPs takes this one step further. So we're providing actionable recommendations to the GP to mitigate or structure around many of these identifiable risks. Like the IDD process, the ODD process is standardized to ensure a consistent approach across managers, across regions, but with specialization to allow for assessment of idiosyncratic risks for strategies and different geographies. For example, understanding the different nuances of various regulatory environments or the types of servicing or operational partners worked with. When talking about ODD risks, probably the top of the list has to be fraud. We've all seen multiple versions of this in private markets. For example, individuals at LPs issuing fake capital calls or fake invoices. But really, it's about all of the areas that support the investment function. Compliance and regulatory, so governance issues, systems issues, think trade operations, counterparty risk, cash controls, IT, cybersecurity has really come into focus. All forms of business continuity risk, really. Valuations and accounting are a huge area of focus, as well as organizational risks. Again, we cover organizational risk in IDD as well, but in ODD, this includes things like educational verification to ensure no one's faking their credentials. You'd be surprised how often we actually see that. Appropriate educational verification. They actually got the degree they got. They actually worked where they worked with the title they put on their resume. It's
And the name is George Santos?
yes, that's when they want the gold star resume. Yeah. It's true. We've actually done Google searches and people copy certificates right off of Google Images. It's quite remarkable the links people, or lack of links, people will go to fake credentials.
The lazy faker.
Yeah.
Yeah.
Right. Also, we're trying to siphon out. So the good news is a lot of these can be really cleanly identified and mitigated on the ODD side through improving policies and improving procedures, better cash control, separations of duties, disclosures. Every week, almost every day, Allborn's providing recommendations to GPs based on industry best practices, which Allborn is also heavily involved in shaping via various industry groups. But we and you, LACERA, also benefit from Allborn having done thousands of ODD reviews before. We've seen the good, the bad, the ugly, the lazy. We also know what areas are ripe for risk, but we also know what areas are ripe for LPs to push back on. If you could flip to the next slide. Thank you. So I won't go through all the points on this slide, but I do want to reiterate 3 points in particular. First, our specialist teams and this large, centralized, scrubbed data set are critical building blocks for risk management. It's a lot of work to turn data from around 40,000 funds we're tracking into usable, actionable analysis, but that's what we're doing with your team. Second, that analysis includes what is needed to measure, monitor, and manage risks across investment, portfolio, and economic cycles. It's a matrix. And third, the output is a set of reports and tools that cut through the noise and leverage the expertise that our teams bring to your portfolio. With that, I'll pass it over to Stepstone. Thank you.
Thank you. Next page, please. So starting very big picture, in the public markets, securities trade every day on centralized exchanges with a lot of disclosures about the company. So there's an enormous body of data that goes back a century and more. And they make up the preponderance of investment portfolios. So there's a tremendous body of experience. And from there have come best practices that we also use in the private markets where we're not blessed with as extensive of resources in that arena. We do have to adjust for what is different about private versus public markets. And, one is that their private information gathering is much harder. And another big defining one is the illiquidity. Once you commit to an investment, you are, for the most part, stuck in it. So there's a lot more focus on the entry decision, and you don't have the market to kind of vet the manager. So we have to do all the things that we just heard about internally. Three of the most important guiding principle best practices from the public markets are that top-down planning and asset allocation have by far the biggest impact on the portfolio, actually more important than individual stock selection, although they both matter. Two, that thoughtful diversification is one of the most powerful risk mitigators available. And I say thoughtful because you still need room to make active management decisions. And the third one, of course, is to seek compensated risks and avoid uncompensated risks. And the way we leverage these on the private markets and at Stepstone and LACERA is really with systems and processes. So things like the structure review, the asset allocation, the investment policy, the due diligence policies matter enormously because they establish a set of detailed guardrails. And yesterday there was some discussion, and I can't remember the word you used, but talking about the concern that a board member would kind of take you in a not useful direction. If you are hitting these guardrails, if you are trying to allocate to some place you're already fully allocated, or if you have a due diligence report that has a lot of red flags, this is off market, those are signs that you're moving in the wrong direction. And that's where this structure helps give you important information for decision making. Next page, please. Because the private markets are private, we have to also adjust for the lack of data. And technology is our friend in this arena, and Stepstone has very much leveraged that to your benefit. Performance data is limited. It's really hard to figure out, how well you did, but you don't know how well you did in context of what your other choices were. And that's why we try to collect data to put that in context. The indexes are increasingly helpful, but they're not perfect and they're not great. So even that is of limited use. You still have to do a qualitative overview. And of course, it's all lagged because in many cases, both the investment structure and the assets are not trading. So somebody has to do an appraisal and figure out what they're worth, and that takes time. Another aspect is if you want to invest in public stocks.
Excuse me. So that appraisal that's done by an independent party?
Yes, there are actually very extensive processes where there are third-party, I can talk better about real estate, but there are third-party appraisers, the fund manager gets things audited, and then you have an audit, and all these different steps make sure that the processes are being followed. So if you want to buy a stock, you can look up in a nanosecond on your phone what makes up the S&P 500, for example. If you want to invest in a private equity fund, really to this day, you mostly know they're available because they're knocking on your door or you're knocking on their door. There isn't a list. And so Stepstone has put a lot of resources. We actually have a list. It's called SPY, and it has a list of tens of thousands of managers. The real estate team is on track to meet with 1,000 managers this year, and we collect a tremendous amount of data so that you can figure out if there's a manager that you're excited about and a strategy, but wait, there's 17 others. And by the way, a few of them have outperformed. So this data helps you really know that you're taking a comprehensive look at the markets and kind of sieve through to the best fits and the best performers. And we do actually serve an important role in helping you solve for that particular problem, although your team works in the marketplace also to figure out what's worth doing. Anytime you're gathering more data, you have more information for risk management. That's one example. Asset level performance data is another very important one that particularly in PE, we have a tremendous database to help put performance and choices in context. And then finally, I mentioned the issue, the one risk that is really different is the illiquidity. So liquidity management matters. And we have pacing tools that help with that, also leveraging technology and data, because you actually have to project what capital calls and distributions are likely to be. And we have that is a quantitative process for us, leveraging our data. So these are some of the data issues that you face when you're thinking about private markets. Now, on the next page, please. Oh,
Madam Chair, if I may. So I think my question to Milliman yesterday, I think is a little more, so I asked if, because of the lack of information, it sounds like you guys independently are collecting this data in mass and building your own, book. We talked about that, who's wrote the bad check, right? So, and because of that commitment, once we enter into a relationship, I asked if it was part of the actuary, discovery, if they had some, because of the lack of data, if they were able to calculate for it, for funding and whatnot. But I think it's more important here. So when that relationship's established, what happens if everybody gets fooled? What is our process? If we're bound to this contractually, what do we do? And I don't know if you're going to move on to that later on, but.
Do you mean like the valuations don't turn out to be what they were claiming they were, or?
Correct, or the manager's just full of it, so to speak, and, so to speak. Or some environmental or social thing, something impacts that, but I mean, that's, a different thing, but if there's,
I'm going to talk a little bit about the processes to find that out before you go into the investment. And that's your best chance, because then you don't invest. And those are very extensive processes. Once you're already in, the answer is kind of, it depends. And it depends on the legal document that you have that sets that structure up, right. Which does have remedies if there's actual fraud. And often there are other remedies. I don't know if you want to jump in.
I would add, or a thought to the question or the topic is, there's a difference between a bad investment, that there's no guarantee that any investment is going to be good. And that's why we spend a lot of time underwriting an investment, but maybe more importantly, monitoring an investment. And it's going back to the comments made by Alborn about there's blind pool risk, such that we're constantly monitoring the portfolio to try to identify early warning signs as to, is the investment not living up to expectations? And that's why we participate in limited partner advisory committees. That's why we have systems to really understand that we're being compensated for the risks. The second part of your question, and this may be where Margaret was going to go, is if there's a contractual breach. And if there's a contractual breach, that's why we spend a lot of time, and Mr. Rice has built a team to really help us from a documentation perspective to make sure that we have lots of rights when we go into an investment. So I think that the answer to your question, may depend if it's just a bad investment, the manager isn't living up to expectation, or if they violated a contract. And if they violated a contract, we have recourse. If they're not performing, we can choose not to invest again, or we can look to exit the investment.
And then with the things like the human error, I mean, things unforeseeable, human error, market error, a pandemic, for example, something of that nature. But okay. And
there's also, and this may be partially legal, and I know Jose is an attorney, he can maybe speak to, is that there is a standard of care, and for human error, and this is part of, and I have it in my CIO comments for later today, is about the SEC private fund rules about potentially lowering the standard of care in some cases. So I don't know if there's a way to answer that.
Yeah, I don't like to talk about my past as a lawyer, but I'll. I did practice for 7 years doing partnership law, so doing this kind of agreements. And fact is, we had a 40-year history of negotiations of partnership agreements in private equity. So they have been finely tuned to address what we can expect, right? Issues that we know can come up, like fraud or going beyond the guidelines and all of that. And those are all well covered. there's a question about what we didn't expect. What are the remedies if something happens that is not addressed in the limited partnership agreement? And we were going to talk about this during the Q&A, but I'll bring it forward.
I can wait.
No, it's okay. But an example being the financial crisis, Lehman Brothers goes bankrupt. They manage a few private equity funds. Never happened before, where the general partner is bankrupt. Who's going to manage that, etc. And that's where there's advisory. Every partnership in private equity has an advisory committee, and LACERA participates in many of the investments that you make as an advisory board member. That is an avenue that allows you to address a lot of these unforeseen issues as they come up, and have influence over what the outcome is. And so in that example, the advisory committee got involved and was able to find a replacement general partner to step into the shoes of the bankrupt general partner. That's a completely unforeseen circumstance where he worked for the LPs because they had a seat at the table, literally, to decide what the outcome would be. So when those things happen, the advisory committee can step in and do that. But your partnership agreements, again, given all the history, address most of the issues that do come up, unfortunately, over and over again. Particularly, the key person leaves, what happens? That's all addressed in the partnership agreement.
Gotcha. So and that observation is part of that OODA loop. If since that we have that relationship, we're involved with them, that, if the manager does call an audit, I mean, I'm not saying it necessarily has to be fraudulent, but if like a manager calls an audible.
Yeah. If they go off, as Margaret was saying, you have the guardrails, right? So if the manager veers beyond the guardrails, what can you do? And there are remedies for that.
And can I just also add just that I think it's underappreciated here at the kind of board level. Once we make an investment, the degree of effort that goes into negotiating the final terms of the contract are actually substantial. And Steve, I would invite you to kind of, if you want to comment on the post-investment decision-making to the final contract date. Can you tell us a little bit about the effort that goes into that, just so that we're aware of what we do legally to ensure that our contracts, which, as Margaret rightly mentions, is your only avenue of recourse when things go wrong?
Including how we enforce the side letters that accompany the contractual agreement.
Yes, good morning. I appreciate the question. We have a team of in-house lawyers, and we also have a large team of outside lawyers who, once, even before the board makes a decision, preparing for the potential of a decision, begins to review the documents and negotiate the documents and position LACERA most favorably. The tool that we use most commonly is the side letter, where we get unique terms that are applicable only to LACERA. They cover things that we care about. We try to acquire as many ownership rights for LACERA as we can, even unique from the rights that the general partner will grant in the fund documents that they prepare. And we are successful in achieving those unique rights. And in the past, we've been fortunate that we haven't had investments that have gone wrong in the sense that we've had to invoke those rights. But when something does happen, those terms that we negotiate really, really matter. And they can distinguish our ability to obtain a recovery or obtain another remedy from those that other limited partners may be able to achieve. In the past 9 years that I've been here, we've only had one situation where that's occurred, but because of the rights, and entirely because of the rights that we had negotiated in the side letter, we were able to obtain a recovery that no other limited partner was able to achieve. So we spent a great deal of time negotiating our side letter rights so that we have the legal protections that should something, all these safeguards that are being discussed, all the diligence somehow goes wrong, or there's affirmative misconduct, which would be the most typical situation where this might arise, we are situated to take action and obtain a recovery for LACERA. So is that responsive to the question?
Yes, absolutely. And that's what I kind of wanted to highlight. I think it's an unsung and an underappreciated role that happens. You know, Steve, you do the unsexy work here, but it is so valuable, you know, when things go wrong.
Yeah, well, appreciate that. But again, we have a team of in-house and external investment lawyers who really do the heavy lifting.
Yeah, and I'd like to add to that we have seen deals that have been approved by the board, and then later on in the side letter negotiations, the manager actually walks away because they don't want to agree to a separate unique terms. Is that correct?
Yeah, yes, that can happen. But I'm glad you, Trustee Santos, that you mentioned this point, because even though the board may approve an investment, the legal division and outside counsel are still there to ensure that the terms are going to protect our members. And so we may get to a point, and this does happen from time to time, where the legal division will recommend to the business team that we pass, or that we go back and simply draw a line with the general partner that we won't go beyond in terms of standard of care, which has been mentioned, indemnification, controlling law, a variety of provisions. And sometimes we get into that situation, and oftentimes the GP will blink, sometimes they don't. And then we have to just figure out, well, how are we going to get around this? And we do sometimes say, well, we'll come back to the board, because a right is that important that even though the board has taken action, we will come back to the board and inform you that something has happened during the negotiations that you should know about.
Thank you. Thank you. Thank you. Sorry to interrupt you, Margaret, but I thought it was an important moment to highlight that.
Great question, and it's actually part of the presentation. I could hop ahead 3 pages while we're on the topic and finish it off. As part of our due diligence, to the next page, please. One more, thank you. So as part of our detailed due diligence before we go into investments, we do an assessment of the key legal terms versus market, and we do have a database for this, and this is cool. This is a snapshot of what's happening inside of our SPY database. In this case, we searched on and identified that 250 funds were peers of the fund in question. And we can do things like see that 72% of those 250 funds have not only have the right to terminate the GP for cause, which is the situation that Jose described, but you do it on a 2/3 vote. So if the fund you're talking to requires an 80% vote, that's really hard to get because people don't vote, right? So we can say, you know, you have this, but it's not functional. And by the way, our data says you're way off market, which helps us to negotiate them back to the on-market terms. So this is where data is your friend. And this legal due diligence also, by the way, goes over all the compensation for the manager to help validate that the fees that you're paying are on-market fees. So if there aren't further questions, I will put that page in context in just a minute. If we could go back to page 3 pages up. Sorry, I have different page numbers. That one, yes, thanks. Okay, so big picture risk management. We kind of think of it as 3 different layers, the macro, environmental, and what are you trying to do with your portfolio level risk, the actual portfolio construction risk, and then the investment selection. Usually the staff and the board both look after the macro, what's happening in the world. You do things like have BlackRock come and present to you about what's happening in the world. And then your whole asset allocation process, your structure review, is where Makita works to incorporate all the knowledge from that great big block of data that I described in the in the public markets, whatever's available in the private markets, and to kind of bring that all together with your goals to design an asset allocation that will set you on a target to ideally hit your various investment goals, your risk tolerance, your income needs, et cetera. So that is a sort of a seminal part. And there's an overlay every 2 years. We do the structure review. There's like really detailed asset level goals also that help define what the portfolio is going to look like, what the exposures, how many positions, how you're managing liquidity risk. And that is all in there. And then the next step, once you, the board, are responsible for those kind of practices and policies, there's also an investment process and policy. We see with many of our clients a pretty detailed steps as to what we have to do to vet an investment. And many of our clients do have delegated authority. So the staff is actually doing that, and the board more or less makes sure they're doing that. But if they are, then the staff tends to look after filling out the actual portfolio. So next page, please. So some of the big risk management tools, the seminal one is your strategic asset allocation. Tools around sourcing and screening matter, as I described above. Our real estate team is on track to have 1,000 meetings this year. We're divided into sector teams. The sector specialists meet with those folks. They each compile, they rank the managers, they compile a top picks. It goes through our investment committee. So we've sieved down this big universe into who we think are the best choices. We work with your team who's doing a similar process and also leveraging SPY, and they decide which funds they are interested in. And then there's the whole investment process. There's usually, we and your team have very similar processes that we both run. There's an initial presentation of pre-due diligence, and then there's a decision to pursue due diligence, and then there's an in-depth due diligence process, and then we bring the findings back for a vote as to whether to proceed or not. And so both of these processes are important, and they're very similar. It's important that you're doing both. Also, Stepstone's processes are rigorously documented and are very similar across the asset classes. So the private equity and the real estate are similar. It's really important that you put everybody through a really consistent set of guidelines that leverage the best practices across the private markets of how to do things. And that in and of itself is a guideline that you're not having special rules for special things. So it's another guardrail that if you hit it, you should be questioning why, what's going on and should we proceed. Then you have the actual due diligence, and there's the investment due diligence and all the other things. If we go to the next page, Allborn did a fabulous job. I won't go into detail unless you want to, but we look at the organization, the strategy. We really analyze the performance, leveraging all the data that we have to put it in context of what the other choices were. We look very carefully at the structure, as we've discussed, and then other aspects like what's going on with the fundraising. Who are the other investors? Are they going to raise enough money to do the strategy? Operational due diligence, responsible investing, and so forth. And all of this is consistently reviewed and goes into our investment committee documents, which are in the neighborhood of 80 pages long, that your team gets. And we discuss in detail with your team, who's also doing their own due diligence, any kind of questions that come up, and we go back and forth with the managers to get this sorted.
What about valuations? In real estate, you have appraisers, and in private equity, we rely on the managers' valuing the fund. So how do you verify that? What's the process to determine that the property or the fund is properly valued?
There are 3 add-ons to the investment due diligence. One of them is legal review, which we've discussed. One of them is the operational due diligence, which gets at these issues, and one of them is our ESG. So let's move ahead now to the operational due diligence page, which is, I think, 2 more there. And these all are comprehensive reviews by we have a separate ODD team that is not part of the investment team, so we get a fresh look. They do a report, and all three of these, there's a more comprehensive report in the back of the IC memo, but we bring forward the summary conclusions as to whether there are issues or problems to the top. The operational due diligence has a very rigorous process that looks at everything from like how they handle the cash to how they handle valuations and what their accounting processes are, to what's going on with their IT security, to compliance around things like political donations and all that. And this is the very long process that we go through to vet that there are actually proper valuation procedures and that they are doing third-party appraisals on a cadence that's frequent enough and suitable, and that they have an audit process in place with a qualified auditor and so forth. So this is a process we have been through in detail with both your private equity and real estate teams. And so we are very rigorously examining that and other related issues.
And what's the procedure for the private equity?
Yeah, so I've been the same procedure. The difference being that in real estate is best practice to do these third-party valuations, and so almost everybody does them. That is not yet the market standard in private equity in terms of a third-party valuation of the portfolio companies. So it is the manager's responsibility for valuation, although it is getting to be, and StepStone encourages this, market practice that you do use a third-party valuation agent to verify the general partner's valuation, but it's not there yet. So you're relying on this general partner. So the review that Margaret just described in terms of what are their policies with respect to valuation, and then who reviews them, because they do get audited financial statements. So the auditor has to sign off on those valuations. And often there can be pushback on private equity funds from the auditor with respect to a valuation. A little counterintuitive many times, because the valuation is not reflective of fair market value in terms of they keep it at cost, but they should have actually increased the value because there's been operational improvements. So that's a continuing evolving practice. But one important difference with private equity, and certainly almost all hedge funds and most real estate funds, which is that valuations, you want to have accurate valuations because you, on a portfolio basis, you want to know that your private markets portfolio is accurately marked at fair market value. But those values don't affect the fees that the private equity manager actually collects, because they're collecting based on invested capital, not on the fair market value of the portfolio. So there is no real incentive to inflate the value of a portfolio, other than during the fundraising period, where it might look good for them to have better returns than they actually have. So that's why we go through all the processes that Margaret mentioned to validate this.
Yeah. Okay, and then
just before you go,
sorry.
excuse me, Mr. Grable. So what about the valuations that the staff conducts? How hopefully they don't rely on the StepStone, because it's supposed to be separate and independent. So how does the staff deals with valuation?
I'll answer the question several ways. One is for our wholly owned real estate portfolio, we have an appraisal management service that the board approved probably 4 years ago or so. And so that manages appraisals that are done by LACERA through professional appraisals. As it relates to the funds in which we invest, private markets, it's part of our diligence checklist upfront. It's part of our monitoring. It's part of what we seek as part of going to annual general meetings, part of being on limited partner advisory committees to really understand what the methodologies are. And then for other private assets, we've, over the last several years, be it for hedge funds, be it for liquid credit, we have, through our dedicated management account platforms, through, I think in private markets, we've also put in place various custodial relationships to better oversee that aspect of the operations associated with valuation. But it's something that the auditors go through each year as part of the audit of LACERA.
Thank you.
Yes.
Do you guys, for data mining and whatnot, do you guys have access to like SPY or I mean, is that proprietary for you guys? I mean, for data mining.
We have access to SPY. We have access to Alborn's platform. We have access to other platforms, but we also have significant systems investments that LACERA has made such that the data isn't theirs, it's ours. And we have an open RFP right now for more of a private market data solution, but data is really important. And, you know, as was said at the beginning, it's not just having the data, but it's being able to analyze the data to use it in an instructive way to better inform decisions.
Thank you. Okay.
Okay, and then the last element of our due diligence, please turn the page, is our responsible investing diligence, which scrutinizes managers with respect to both policies and practices and how things are integrated in their governance around environmental, social, and governmental issues, DEI, carbon emissions, and whatnot. And we score all managers 1 to 4. That goes in the IC memos. We discuss with them what needs to be improved. And we've been doing this for some years now. So we're starting to be able to, when they said, oh, we'll get it next time, we can figure out if they're getting it next time, right? So that goes into the memos. And then we also have an ongoing screening of the press, et cetera. And there's also an ongoing screening on the ODD world on the legal side. And we have now in SPY, a critical incident data database kind of report if anything gets flagged as part of the ongoing monitoring. So, you know, all of this together and all these processes help you set the guardrails that if you're bumping them, you really ought to think twice. And the investment committee memos are really designed for the investments to identify what all the risks are of a particular investment, whether they're normal, on-market, compensated or not, and whether they're worth taking. And so that the staff or the board or whoever is making decision, you know, has this information to really understand what they're getting into. And again, we do that and your team does that. So you kind of get 2 bites at the apple just for quality control.
Right.
So that's the big picture. I think Jim is going to lead the Q&A now, or the panel discussion.
Good morning, Madam Chair and other trustees. We wanted to keep this panel interactive, or we wanted to keep this session interactive, and we're happy to see there's been a lot of engagement thus far, covering some of the topics we were going to delve into in more detail in the second part of this presentation. I just want to introduce Mark White, came to the table from Alborn, who's going to participate in the remaining part of the session. So I wanted to open it up to the board if they have further questions. We have some prepared questions to delve into some of these aspects in more detail, but I'm happy to at least entertain questions at this point of our panel.
Great. And I think right now it would be great too if we could also just remind ourselves what our relationship is between the board and our consultants with regard to how they interact and kind of act as a second check on our policy goals. Tim, would you mind kind of commenting on that, since that's been part of your governance review?
Sure. And I think, you know, in this particular context, each of the consultants serves directly to represent the interests of the board. There is a lot of collaboration between ourselves, Alborn, Stepstone, and staff, but ultimately the role is one of supporting the investment decision-making process, and then also making sure all the guidelines, policies, procedures, everything that would sort of fall in the scope of oversight are followed. So you all as you're considering an investment or making other governance choices, can ensure that all of the safeguards that have been put in place through the governance work that you all do is actually carried through.
Right, this is the execution of that.
Yes.
Yes, so I just wanted us to be aware of that. So we'll start with Ms. Jones.
Good morning. I had just two questions initially. The first question that I had in understanding the relationship that exists and your role in reviewing investments before they even get to us, I want to kind of understand the process of what occurs if something comes up with the SPY software that is a concern, and how that conversation and that engagement with staff occurs, and is that, how does that dialogue go back and forth between staff before we ever see it? I know a lot of times when investments are brought to us, they've been fully vetted and they've been given the seal. I'm just curious as to the process when things don't go smoothly and there has to be, a deviation, or, they have to change or modifications are made, et cetera. And then the other question that I had was, and you probably just touched on it right when I walked in, I apologize. And that is, what types of things does the SPY software pick up, or what things have you encountered? You don't have to speak specifically on, obviously, where those things got picked up, but what are the types of red flags that have been produced by using the SPY software?
We actually have an example of the first one, if you don't mind. The team was looking at managers in a certain category, and we had gone over with them, and we had narrowed down to a smaller group. And there was one name in the group that had a particularly strategy that was meant to produce outsized income, and it had, but that spread was starting to narrow, and we were worried that it wasn't sustainable. And we really looked into where the properties were, what was going on, and said, hey, we've done a lot more detailed research. We're not too sure about this manager. And there was also some noise about personnel transition that actually turned out to be noise, but it took a lot of work to make sure that was the case. And so it kind of got backburnered. We spent a lot more time with the manager understanding, what was happening. They had a development pipeline that was going to boost income, and, we're getting more comfortable, but it put it on the, and your team is doing their own thing and they will come to their own conclusions. And I'm not saying we're there yet, but it was a yellow flag, and it's going a little slower and more thoughtfully and more carefully as a result of that.
And are there scenarios where you've had to say, we're just not willing to put our stamp of approval on it, or you just produce the report?
If we find that something is not of institutional or appropriate quality, we will call that out. That has not happened with LACERA, and we will call out in the memo what the risks are and whether they're mitigated or not very clearly, so that clients can figure out some people are willing to take risks that other ones are not willing to take. So we will identify those things. We haven't run into kind of any of those issues. In fact, I would actually say that the LACERA Civ is somewhat tighter than ours in some cases, which is not a bad thing.
But there's a lot of dialogue with the staff before an investment ever gets to this room. So there are many investments that early, you don't have to spend as much time as they're spending on this particular opportunity before we both come to the conclusion this is not worth going forward with, right? Mm-hmm. So when you think about the funnel, there is a very, very large funnel of opportunities. Some of them are easy to say this doesn't fit LACERA. Some of them, the LACERA staff may be very excited about, but we may have some issues, or vice versa. We may be very excited about, and we say this is great for LACERA, and staff says maybe not. And we have dialogue over a period of time. It's not one conversation where those get resolved, because we do more work and we get it, and then we come to a conclusion. So, for every opportunity that comes to this room, there are dozens of opportunities where we've had serious discussions and decide not to go forward with.
Yeah.
If I might just add in, we do the same in the asset classes that we're working with you all on. The triggers, those flags that come up, I kind of think of them as a yellow, orange, red type trigger. Reds are no-goes. Others, they warrant further exploration, right? And they're ones that sometimes just require time monitoring. Did that team turnover actually impact sourcing and selection? Others, it's more about exposure, and is the manager actually providing the exposure that you think they are? I head up the private credit research team. A lot of managers are marketing funds right now, calling them structured debt funds, equity-like returns with debt-like downside. When you dig into it, it is equity-like risk for equity-like return. And that's our job, is to cut through the marketing spiel to look at where are you actually attaching, detaching, why are you you're supposedly first lien, squeaky clean. How are you getting that spread you're getting?
Right.
So it's really using the data to have those questions. Mark and I often say our jobs are to get managers to talk about the things they don't want to talk about.
That's the whole thing. I want to point out one thing to make the board more comfortable. I'm the more gray-haired person, I think, on this panel. I've been doing this stuff for 30 years, and I was once a allocator, much like yourself, so sitting on your side. The LACERA methodology of vetting managers, both with Stepstone and ourselves, is one of the most robust that I've seen. They are a team that sits down, and they used to refer to it as the RAGE meetings. And RAGE was actually an appropriate name because it had an opportunity for people from multiple disciplines, multiple expertise within the LACERA team to discuss opportunities. And one of the things, much to my chagrin, because it makes a pain in the butt for me, Jim, is they do a lot of this on a regular basis, but then when an issue comes up, they have an ad hoc meeting. So Stepstone and us will get a meeting notice all of a sudden that this afternoon they want to have a big discussion, and we accommodate that. It is a very robust process. The team really cares, and much as Stepstone alluded to, it is more robust than a lot of others that we do see in the industry. So.
Can I add a couple of thoughts? First of all, RAGE isn't RAGE. RAGE was Real Assets Investment Group. It's not like a W. Yes.
It wasn't a cage fighting
No,
match?
none.
I was kind of impressed the other way.
Except,
RAGE, it's like, oh, it's cool.
but Musk and, I'm ready to take on in the cage. And Zuckerberg.
It's okay, he pulled a muscle.
Yeah. I think just to provide kind of the staff context to this also is when we underwrite an investment, we have to balance two things. On one hand, you have to be the most passionately involved if you're pounding the table to make a recommendation. At the same time, you have to balance that passion with dispassion that you just move on to the next, notwithstanding, the months of work that went into something. And there's a very professional respect that we have amongst the team, that we have with LACERA's advisors, that the best outcome may be not now, maybe just to say no, but we're never going to present something where it's a split vote, because nothing's ever really that binary that that this is the only investment that's good for LACERA. There's never any one investment that is that dramatically important to the fund. And I think that we always have that perspective that every, be it investment committee meeting that we have, every meeting we have with our consultants is a learning opportunity to either learn more, to say yes, or to say not yet, or say no at times, but it's always collaborative. There's never kind of that tension where it's a battle to convince someone, the arm wrestle to say yes. That I've never seen.
And to put that in context, how many investments are we making in a year? Remind us. We know, obviously, but let's just put the numbers.
Ballpark, it's a dozen to 2 dozen.
This is not a huge number. So they are turning down way more managers than we ever see as an investment committee. So we have Mr. Jones. Who's kiosk two? Get to someone else.
Kiosk two. I don't think my name's in the system.
Oh, got it. Tim. Yeah. All right. So we have Mr. Jones. We have Tim, and we have Mr. Santos.
Yeah, I think it was, it might have been Jennifer that mentioned, brought up the term return per unit of risk. I may not sort of be there. Obviously, as we've moved from 17% to 44% in terms of overall portfolio in private markets, it's because of the returns are better. And so we're just trying to be compensated relative to the risk of the asset group. I'd like to, for not only my purposes, but I think for probably other members of the board too, understand a little bit more about that metric, that when you say return per unit of risk, can you kind of help us understand, like, I'm sure there's another metric perhaps, or another analytic that you're comparing it to on average. Our return per unit of risk, are we better than average? Are we average? Can you just kind of give me a sense a little bit of, in that ratio of, as we're doing all this risk assessment appropriately, and then looking at the return, can you talk a little bit, as we've moved from 17 to 44%, how good are we, and then where are we trying to get to in terms of being best in class?
And if you're addressing that to staff, I think in some of the private areas we're in, like including infrastructure, natural resources, illiquid credit, it's a relatively new program. And I would say in general, it's maybe harder to make those assessments because you have to kind of see the full cycle of some of these funds go through. We are very conscious of, incorporating funds and vehicles that, fit our structure review that's designed to contain risk. And so I think we're very conscious of it, but I feel like, the measures that we have indicate that it's working, but I feel like you don't really know, until, the 10 years of an infrastructure fund have kind of played out to that we're, adequately getting compensated for some of those risks. I think in real estate, we have changed our structure. We've had a long-standing program investing in private assets, mainly through directly held assets. I think our view of risk has changed in that we view a lot of those kind of more idiosyncratic risks of owning these assets directly translate into higher risk in a portfolio, which is why we've changed our structure to invest, particularly in core real estate, in funds where we're getting more diversification, potentially more liquidity, just a portfolio that's much more aligned with core risk that maybe we weren't seeing as much in our directly held program. So I think that's an area where we have evolved in the past few years to really focus on the risks we want to take and having a structure that supports that. And that, it's measurable. We should expect to see volatility against the benchmark declining in our core real estate as we move to funds versus separate accounts, and we are seeing that.
And also, I think it's probably worth mentioning that part of the drive to redefine that portfolio was because we were also considering the uncompensated risks we were taking. That was such a huge part of, there was so much complexity and operational burden that we were bringing onto ourselves that we just didn't have the capacity for. And in retrospect, that it made a lot more sense to put that into a structure we could get compensated for and reduce the risk in the process.
Well, like the idea, which was interested just to have a conversation, where I was trying to minimize uncompensated risk. I don't know if it's fair to say we're trying to maximize whatever risk we're willing to accept, the return of that. I just kind of wanted to get a sense of, from a staff management standpoint, like what does that look like, right? Like, is it primarily just zero out uncompensated risk, better define the risk that we're willing to accept within our lines, and then, do we have a certain bogey that we say, then here's a target risk on those that we identify that fit in our guard line that we're willing to do, and if we can't get that, then that also qualifies as not a good investment, right? Even after everything looks to you. So I'm just trying to get a little better understanding of how you all think about that.
I mean, I can address maybe that from a staff perspective. In terms of uncompensated risk, I think, the real estate example is as Ms. Sanchez had mentioned, that was really designed to eliminate a lot of uncompensated risks that we had operationally. And so we think that, the structure that we're moving to will help us, get a better unit of return for the same level of, or for maybe a lower level of risk with the same level of return. So I think that's one area that, we've done that. And that, I think we're making a transition in the real assets portfolio. We started with a public market investments. We think we're going to earn higher returns, and every indication we're seeing in the funds that we've invested in, we are earning higher returns than what we can see in the public markets. And so we think that's a trade-off worth making, and that we're getting compensated for the illiquidity of being in private structures. I think maybe in hedge funds, I'm not maybe as well versed to speak about that, but it's been a while since I worked in that area. But maybe there we have seen more recently, as we move to direct hedge funds, we can measure our success in that program in terms of measures like that look at return per unit of risk, like Sharpe ratio, and that has been very successful in adding returns that are in excess of cash at a very low volatility.
Great. All right. Jim?
Perfect. Thank you. I just kind of wanted to take a minute to go through, the process that we all go through, the concurrence process, right? So I think the board oftentimes is processing a large packet of the one or two investments that are getting reviewed and approved at every board meeting. I think there's a perception sometimes that there's always this rubber stamp from a consulting organization that's working with a staff on producing those ideas. But when Alborn or Stepstone are working on private market searches, they're starting with that universe of tens of thousands of different strategies that are out there, many of which are high quality. So just to filter it down to, let's say, the best 50, which you can actively do work on, already goes through rigorous quantitative analysis, other screening, and that's sort of where the conversation likely begins with staff. And in the framework of public markets where we're involved, there's the design process on the RFP, right? So you're already trying to predefine a universe of good, high quality opportunities within a particular area of the market that you're looking to invest further capital. So, and some of that gets vetted at the board, and the board is approving minimum qualifications for RFPs. And then when you get further into that funnel, there's a lot of back and forth. So we may have our top 5 or our top 10 based on the research process that we're going through. Staff will also do that. And in each one of the memos, we try to capture as much of the process, but process isn't all that exciting to write about. And so we're certifying that as we go through this screening, our top 5 may look very different than staff's top 5, but then we still are able to probably arrive at a top 3 that do overlap. So we've already gone through all of these processes and improvements, and then it's picking the winner from amongst that, like already thoroughly vetted, and sort of collaboratively produced top list. So I don't want any of that to get lost on the fact that what you're seeing from all of us is a concurrence memo, because there's just a lot of work that goes into getting to that point to begin with.
Yeah, and I would reiterate one of the bullet points of the listening tour that I went on, which is that there is a healthy tension between staff and our consultants because of the design of the accountability structure that we've created. And when I hear that tension, it just reinforces that it's working. So, Mr. Green?
Thank you, Madam Chair. Quick question. So this risk management process, it's common for all public and private investments. It's the same kind of process.
The way I would answer that is, I think the risks that we face in private markets, there are a lot of unique risks that we just don't experience in public markets.
I understand. I guess let me clarify just the process itself, the evaluation. We have, Madam Chair, identified it as friction, but I would say redundancy, right? One group, whoever comes to the conclusion first, there's that dialogue. But it's the same process, right? It's the.
Yeah, I mean, I think
Short answer, is that fair to say?
I think, when we talk about the risks in public markets, I think a lot of those risks in our process are managed by our public markets teams at LACERA, as well as our relationship with Makita. A lot of that comes out of the strategic asset allocation process, which uses two key risk and diversification measures, volatility and correlation, to kind of help set our portfolio. They also work with our public market teams in terms of, structuring portfolios to, minimize risks like tracking error, or, figuring out where it does make sense to take risks within the public market sections. But I feel like those risks, the way we assess and manage those risks, are somewhat different than what we were doing.
Actually, Mr. Rice, I think the question was, are you running parallel processes within
okay.
public
Yes.
or within?
Yes, that is the case for any manager.
I want to follow up with a comment. So in the fire service and in the military, I guess I'll just open with, I'm and on the record, and for the people that we're serving, the membership, the retirees, I have great confidence in this process. It parallels, the OODA loop, if you guys are familiar with that. Observe, orientate, decide, and act. And that loops back around to the reevaluation. In the fire service, we have situational awareness, what's going on. You could translate that into, there's a risk of loss of life or limb. In these other avenues, there's a risk of loss of revenue, capital, and our members' benefits. So you just need to change a couple of words in it. So, the need for the investment or whatnot, the risk assessment, the risk controls, right? And the decision point to engage or not engage, or invest or not invest. And then that goes back up top, and you do a continual reevaluation. And I just want to say that for myself, getting a full grasp of this process, almost in real time now, I have great confidence in it, and I appreciate the work and the collaboration between the two, and having that. Sometimes some people don't like to hear something, but as long as that discussion is going on, it's a pure process. So,
Great.
That's my comment.
Thank you, Mr. Green. Ms. Jones.
Yes, thank you. Trustee Green just touched on my question when he talked about the loop, which is the reevaluation process. And so I was curious to see Stepstone and Alborn, what process, if any, do you go through once you have given a report on an investment? And there are some things that are highlighted as maybe low risk, that we still move forward, but these are things we should be aware of. Is there any review, down the line to assess that those risks have either been eliminated or have not grown into more moderate, or right? Have they turned to a red flag? So could you tell us about that process, if any, that you go through, and if it's not through your organization, if it's staff, if staff could share that process with us?
Do you want to start?
There we go. Yeah, that's actually why I stepped into the panel here, because that is actually a big part of my responsibility at the firm, and similar individuals such myself, highlighting the real asset component of the portfolio, which is new, and it's probably the best example. One of the challenges that I have with boards, as I said, I was on your side of the bench long times ago, and you have to know what questions to ask, but you have to ask meaningful questions. And the worst thing that can happen to a board or investment staff is they get bogged down in data that is non-actionable. And that basically takes up a lot of effort, and it is meaningless. I hate to be blunt on that. It is totally meaningless. So when you're looking at risk in a portfolio, you have two options with risk always. You have the option to either mitigate that risk, how do you reduce it, or you have an option to determine, should I get compensated for that risk? Risk is not something to be feared as per se. Risk is what you're in the business of doing. You take risk, you get paid for it. So what you want to do is you want to make certain that you know the risk. Well, in the case of infrastructure, as Jim has alluded to, there's not necessarily a lot of data. When we talk about real estate or private equity or public markets, there are decades worth of data. When you talk about infrastructure, there is data going back to 2006, and I would question that data is not reliable until about 2010, and then it doesn't get robust until about 2013. So people like myself come in and think about, well, what should we look at when we're looking at risk in that area? And I challenge to say, the first thing you want to know is, why does something occur? Prices move because risk moves prices. So we take the approach of looking at what are the risks that moves the prices. In the absence of 20 years of pricing history, we do have 20, 30 years of risk history. We understand the influences and factors on these variables. So we collect risk data that is not yet translated into pricing data simply because of the duration associated with the assets. We have these discussions internally in our investment committees. We have internal committees, much like your staff have. And we also have development and process committees that try to look and adopt new measures, collect new data, new information, but make it actionable. And I think that's a key thing that we're always looking. As we see it was pointed out about the pandemic, that was an unanticipated risk. And there's a risk that no one was compensated for, but it was a reality. And it was really a matter of how do managers judge and manage that risk? How did they perform with respect to their assets? So we developed new measures to determine the reactionary components associated with the GPs to see how they incrementally protected value, because you couldn't add value through that area, how they incrementally protected value, the processes they had in place, and the speed at which they could respond to situations became a critical factor associated with it, especially in the transportation sector. So these are all evolving, and you have to always make new measures and new processes in place, realizing that some older measures become redundant or less useful in time as the market realizes that risk and determines the proper compensation factor associated with it. So we're constantly looking at that, developing that process. And one of the things that we have worked with LACERA on is developing a new risk metric, looking at the asset level analysis. One of the key things in real assets is it's not the portfolio, because it's a lot of beta. It's actually the individual assets. You asked questions about the legal recourse. Well, legal recourse is only strong enough as long as it's an asset that you actually understand and you know what your levers are that you can actually pull with respect to that. If you have a shipping port, that is going to take a different course of action than a IT firm that might be going wrong in your portfolio. So you cannot have the same homogeneous process to attack these particular situations. Thinking about that.
Can I ask real quick though, with that, and I agree with you 100%, you have to have it through a different lens, right?
Yeah.
So do you go back and look at those same investments to reevaluate them with a different lens? Is that process in place?
Every time you see a change or a shift, you apply a new lens to it. And we have a process in place through the data collection, the QDD that Kristen had pointed out. That part of the process is looking and collecting data information, and reapplying that lens to existing opportunities. When you're looking at existing opportunities, that leads to forward opportunities. And as mentioned, the key thing, and one thing that LA has done very well, is when they've seen a perceived uncompensated risk, one of their options has always been, well, let's see how we can actually get compensated for it. And they have taken active steps to do that successfully with one particular transaction that occurred a little over a year and a half ago. And they have actually looked at and walked away from deals because they did not believe they can get compensated for that uncompensated risk.
Great, thank you.
All right, Mr. Santos?
Yes, thank you. So in all processes, not every process is perfect. So there is always a failure here and there. We call it loss ratio. But my question is, do you have a process in place to evaluate those failures and for purposes of determining why and how was it that we went that rabbit hole? If you can elaborate on that, I appreciate it.
Yeah, post-mortem is always the funnest. Basically, when you're looking at a failure, you're trying to determine why was the failure, number one, not spotted? Why was it not indicated in advance? And then number two, what is the remediation that we can use? And there's an active process every time you see a failure basically review the situation, analyze how steps can be improved, and then go through an implementation process. Coming back to the loop, dealing with military and fire transactions, I refer to it as the fire triangle. My background is in that area as well when I was a lot younger. And you have to basically, it's all about a re-review. You always have to re-step and going through that process and challenging. Analysts have to defend their positions, and it's my responsibility to challenge those positions. And in that process, we come up with a working mechanism that we can reapply and translate to other areas.
What about staff? How do you deal with failures?
Well, I think the point was made by Mr. Rice that we've had only one situation where we've had to take action where we felt like there was a risk that we needed to address in the fund structure. I think there's a lot more issues that just relate to specific assets that I think, as an investor after after a commitment's already made, I think that's where having our LPAC structure, where we do have potentially the ability to, have a dialogue with the manager about how they're managing a particular asset and, what alternatives there might be for some of those. So I think that's one of the ways that we do it after the fact, after a decision is made that may not be, a fund failure, but just, maybe an impaired asset.
I would also, I think what I'd like to highlight, I mean, granted that there are still ways that even those fail safes can fail. And so we're always diligent. And that's, I think, one of the reasons that it's important to create transparency and accountability within the team, so that if you make a bad decision, lots and lots of people can observe that and have input into it and keep us from sort of, what might be an emotional or, quite frankly, a quick decision. We're all busy and we make a decision and it's maybe not the best, most optimal one. It is helpful to think that your team members also have your back. And I think one of the messages I've heard from our consultants, and I've certainly seen it in action, is that our internal process at LACERA is extremely rigorous. And I do want to make sure that we kind of walk away with that appreciation. But I'll hand it over to Mr. Grable to have more comments. I see you're up and ready.
Yes, I feel bad that I keep tapping Jim on the shoulder. I would say there's a structural way that we have kind of learning from investments, that either the underwriting wasn't the best underwriting or there were questions that we didn't anticipate, is we've moved back to in-person committee meetings. And I think that makes such a huge difference, because during the height of the pandemic, when we were having our committee meetings via Teams, once the meeting ended, it ended. Now, when we're in the room, the conversation continues. And I think that there's a lot of unstructured learning that happens off agenda in those moments that, once again, isn't agendized, but I think that really adds to the group knowledge and makes the subsequent discussion better.
And I have pushed, obviously, very strongly for the formal post-mortem learning process, which is not meant to sort of, highlight the person who signed the memo, but really is meant to focus on what about our process didn't catch this? Was this truly something that we couldn't have anticipated, and therefore, we did what you want to know that you did the best job you could have, right? And in retrospect, you always have way more information than you have at the time when you're making the decision. We make decisions with imperfect information. So the question is there something about our process that we could improve having gone through this experience? And that's why I believe that post-mortem, and sometimes we terminate managers simply because we've done a portfolio construction review and they no longer have a place in the portfolio. And that's why we terminated them, and that's documentable. But in the rare occasion that we go through sort of a painful impaired asset, it is important to say, what was it about this impairment that we just didn't see coming as a group? Do we have some systematic blind spot in the way that we look at the markets? And if you don't do that, one of the reasons I think postmortems are also very important is that it does make the decision to go in that much, because if you know that if this investment goes bad and your name is on it, it gives you that much more accountability and sort of, responsibility that you don't want to be that person that's on that memo that we only would review one or two, I would guess, in a really rare occasion. Do you really want to be that, do you want it to be yours? So it does create the tension to make sure that we enter investments with the best diligence we possibly can, but also, that if there's something that we could learn from it, then let's learn from it, right? Let's never let a mistake go to waste. If you're a learning organization, if we are going to be the kind of organization that is best in class and is at the top of the ranks, we are going to have to take some risks. Part of that means we will make some mistakes, and we have to give ourselves a structure to make those mistakes safely.
Madam Chair.
We have Mr. Fila, and then
if I could just add in, there's an awful lot of active risk monitoring and management going on that you all don't see sort of post-investment. You see some of it trickle through in the form of manager scorecards and the quarterly reports. There's a quarterly meeting that's a deep dive that involves all of the consultants, all hands staff, typically runs 3 to 4 hours as soon as all the reports are ready, involves, top to bottom, the LACERA team from performance analytics, and even the folks from MSCI contribute to this. So it looks at every single aspect of the portfolio, gives tremendous transparency. Each asset class group talks in front of the full audience. All people in the meeting are free and open and encouraged to ask questions regarding the performance of any underlying investment. So, and that's just one example of things that, as a board is something that doesn't come to your attention and you're not seeing, but is part of that ongoing risk monitoring process. And in private markets, there are less levers on what you can do, but certainly we've had examples where we've terminated public market managers. The folks from LACERA staff are on LPAC committees. The folks from Alborn and Stepstone are participating possibly in some of those as well. Annual general meetings. We're having quarterly meetings with the investment managers. We receive all these robust data packages. And unfortunately, you can't see all of that, right? Mm-hmm. That's all the work that's getting done. And it does get filtered and processed, but it may just look like a scorecard when you all see it at the end of each quarter.
I appreciate the comment. Thank you, Mr. Green.
Yeah, thank you, Madam Chair. Marcus said something, there's a lot of data to process, and in the spirit of education, for onboarding new trustees, and I don't know if, not to burden staff with extra work, or maybe this is for Mr. Lugo, but as a baseline, a foundation of this process, maybe, because this is very complete with your guys' process and your guys' process and understanding staff's process, but maybe to, compress it into its fundamental, the core processes.
Flow chart.
In essence, a flow chart for onboarding trustees, especially, to really get a grasp of this, and then the additional stuff that comes along with it, the detailed stuff that needs to be looked at, but knowing where to look and what to look, and then that you can build off of that. So I would ask, maybe this is for Mr. Lugo or to in that inboarding packet, something very simple, of this risk management process, because like I said earlier, I'm confident in it, and it's very complete and thorough, and it seems like a very good relationship based process that is taken seriously to manage that risk. And I like what you added, which I didn't think. Sometimes that risk can equate to a greater profit or a better contract. So that's something so that would be a recommendation. I would ask staff.
Can I just maybe address? I know one thing we do on the private market structure reviews is we include that flow chart of our investment process, what all the steps are that are involved in making an investment decision. And so I would look, when we bring these forward, that will generally be part of the package that we're using to communicate these structure reviews.
Yeah, I wholeheartedly agree, though, that this should be like this is the typical process we employ here at LA County, so that new trustees they don't have to go and find that. You may not know to look,
Right.
And so it is helpful as as an onboarding educational process that we come into our first meeting at least knowing that there is a structure and that this process happens.
It is included, but I guess kind of cutting off all the fat and having that just be this is again a baseline, the foundation of the
Yep.
Yeah, super. All right. Any final closing questions? Well, this has been a really robust conversation, and I appreciate both Allborn and Stepstone for the work you did to distill what we know is a complex and painfully detailed effort that you take on our behalf. And, Mr. Fila, thank you for kind of chiming in that overall perspective. I think for us, it is important that we continue to learn and understand kind of how the machine works, because we only look at the tip of the iceberg when we see a final investment memo. So
can I just conclude? We had one final slide
remarks.
on slide 24.
Closing
If we could
remarks.
pull that up. I think we covered more of the staff role, I think, in this process than maybe we thought would get covered in the Q&A. But we just wanted to highlight, some of the takeaways from this session, that, we do have multiple avenues that staff is using to evaluate risk and potential investments that we're considering. So we just tried to highlight some of those on this graphic. I think the big thing is we have invested more in tools that help us assess some of these risks. We also think, we've partnered with, two of the largest alternative consultants that we think also have excellent tools that help us in our process by engaging with these consultants. So, our evolution, as we mentioned, our structure is moving to more complexity, more private assets. I think that's kind of the theme in the next section. So I wanted to just leave that point out there as a segue for the section that we're going to have after the break.
Okay, thank you. Thank you so much, Jim. That was excellent. So it's 10:11. Let's go ahead and reconvene at 10:30 a.m. And we will take a walk down memory lane with the evolution of LACERA's portfolio.
We also have cookies and pastries in the back of the room.
Recording stopped.
And this is for Mr. Jones. He wanted cookies.
Until Linda takes her seat.
That was blocked over there.
Recording in progress.
Okay. I would like to thank Trustee Jones for demanding cookies this morning. Yeah. Okay, so we'll go ahead and pick back up at the evolution of LACERA's portfolio. And apparently, we're going to begin with a pop quiz. Is that right? And there are prizes.
Madam Chair, if I may.
Yes.
I'd like to introduce the team before we do that.
All
Would that be
right,
okay?
let's do it.
Thank you. Good morning, trustees and guests. Our team is delighted to present to you the evolution of LACERA's portfolio. I'll introduce my team that was part of this presentation. I have Magdalia Armstrong from Global Equity, Kwak Nguyen from Credit and Risk Mitigation, Shelly Tilaye from Private Equity, Esmeralda del Bosque from Portfolio Analytics, Inga Tadevosian from Real Estate, and myself, Mike Romero from Real Estate. So right now, I'll pass it over to Shelly and Inga, who will provide you with the pop quiz, and hopefully we get some good participation.
Let's see how we do.
Good morning, trustees and chair, and everybody here. Welcome to this morning's session. This is the fun facts part of the show, I should say, you know.
If we can please go to slide 24.
This will be in the lighter vein. I'm going to explain a few rules to you, quick rules, and then we'll go from there.
The rules are Gina wins.
So basically, the rules are that there are 4 questions coming up. I'll ask 2 and Inga will ask 2 questions. You have 4 alternatives. And then please raise your hands. There are prizes for getting the answers right. And of course, at the end of the session, we have bag grabs, grab bags for you out here with the LACERA logo on it. Please avail of them. Without much ado, let's begin with the pop quiz. So the first question is, the pension fund was established as a retirement system. They already know the answer. I'm so glad about your enthusiasm.
Liar.
I'll give it to Miss Gray, please.
Woohoo!
You've got the answer correct.
Anyone
Mrs.
ever
Gray
wonder
gets a
why we call them
prize?
37 Act funds?
That was just amazing responsiveness. I've never seen such quick board members. Melissa, can we take question number 2, please? Thank you. So how many total members does LACERA have as of July 2023?
Total. Both.
Total.
I'm going to go with D, 190, 590,000.
You've got that correct.
Wow. The man
Thank
who
you
knows
so
our
much
funds
for
ratio
playing.
to the decimal place, by the way.
Thank you, Shelley. Good morning. Moving on to question number 3. For this question, we go back 20 years. Back then, what was the actuarial return target?
Oh, okay, Patrick.
I'm going to take a guess. I'll go B.
No.
Correct. The answer was B, 8%.
Nice to be the historical.
Question number 4, please. When was the Board of Investments established? Your board.
That's a real stumper. Okay.
Just shout it out.
Just shout it out. Ms. Jones.
Anybody?
1981.
73.
73.
That is not the correct answer.
71 then.
I'll go with 81.
71 is the correct answer.
Ms. Jones.
Well, thank you for the participation. We will now turn it back to Mike. Thanks.
Thank you.
Good job.
All right. Thank you,
Don't know
Shelley.
your history, you are doomed to repeat it.
Oh my gosh.
Another board.
Thank you, Shelley and Inga, for the pop quiz, and trustees for participating. So if we can please go back to slide number 2. The purpose of this presentation is to provide a background on why and how LACERA's portfolio has evolved over time. We will focus on the past 20 years, but some charts may have different time periods based on the availability of the data. We will provide an overview of the changes that have taken place over the past 2 decades and highlight several of the significant initiatives undertaken. We intend to discuss things that we've learned over the years and how LACERA has evolved in response to those learnings. And we also will go over potential enhancements that can further advance LACERA towards best-in-class investor. Moving to slide 4. As we talk about LACERA's evolution today, we thought it would be interesting to show where we started. The screen illustrates a LACERA financial report that goes back to 1936. We had assets of $5 million with 8,500 total members and 35 retirees. A lot has obviously changed since then. Moving to the next slide. Today, we are $74 billion. Our path to $74 billion has been rooted in our mission. Board's policy decisions have driven the necessary evolutionary changes. And LACERA strategic initiatives are embedded in all aspects of our portfolio. It's important to note that LACERA's evolutionary changes have been proactive and intentional to face the challenges that we're going to go into further detail in a few slides. On slide 6, since 1980, achieving LACERA's actuarial rate of return has become more challenging with each passing decade. Historically, the actuarial rate of return was higher in prior periods. There have been 2 primary headwinds in meeting our 7% return. First, a decreasing return environment, and second, the increasing plan liabilities of a maturing pension. In the next 2 slides, we'll discuss each of these challenges in more detail. At the bottom of this page, we summarize key milestones that have taken place in response to those challenges. And they include adopting a strategic initiative and work plan, transitioning to a functional strategic asset allocation, allocating more to private market and other illiquid strategies, and continuing to expand our in-house staff resources and operational capabilities. We will also go into further detail with these changes throughout the presentation. Moving to slide 7. Here we show a chart from Makita on how expected returns for risk assets have dramatically decreased since the 1980s. Looking at the boxes in the orange dotted lines, in 1980, the 10-year expected return for a 65-35 stock bond portfolio was 15.4%. Fast forward to 2023, that 10-year expected return has dropped to 5.4%. In 1980, it was almost 100% certain that a 65-35 portfolio could earn 7%. Today, this probability has dropped to about 32%. Investors, including LACERA, have added alternative assets to the portfolio mix to increase the probability of meeting their return requirements. On slide 8, this slide shows that LACERA is a mature plan. We included a couple of charts from a prior Milliman presentation. The chart on the left illustrates LACERA's declining ratio of active members to retired members over time, and it is expected to continue to decline. This is typical of a maturing retirement system. As plans mature, benefit payments can increasingly exceed contributions coming into the system. This can result in higher contributions to the plan sponsor in years when the pension plan produces negative returns. The chart on the right shows the projected employer contribution rates as indicated on the y-axis. The blue line shows if we lose 10% today, and the yellow shows if we lose 10% 10 years later. The latter will result in LACERA being underfunded by 9% as opposed to being fully funded at the end of the 25-year period. However, in both scenarios, we could expect to see an increase in the employer's projected contributions rate from 25 to 35%, which is impactful to the plan sponsor. As a mature plan, the employer contribution rate is becoming more sensitive to investment gains or losses. Recapping the challenges that we've shown on this page and the prior slide, point out that on one hand, return expectations have gone down over time, which has required LACERA to take on incremental risk and complexity to meet our return target. On the other hand, the need for LACERA to be mindful of risks, negative returns, and large drawdowns are ever increasing as our plan becomes more mature. Over the remainder of the presentation, we'll show how the portfolio has evolved in response to both of those challenges. I'll now pass it over to Magdalia.
Okay, thanks, Mike, for providing that backdrop and the changes to the pension plan that have gotten us to where we are today. Now we're going to take a look at LACERA's strategic allocation over the last 20 years. In observing the pie charts, if we go to 2003 first, and looking at the blue section, you can see that the fund had 83%, or 21 billion approximately, of its assets in public securities across stocks and bonds. The remaining 17%, or 4 billion approximately, was in private, less liquid assets across private equity and real estate. Moving on to 2013 and focusing on the green area, you can see that you can begin to see a slow shift towards private, less liquid assets with 20%, or approximately 8 billion. And while private assets only increased by 3 percentage points since 2003, assets in this category doubled, going from 4 to 8 billion. And looking at current day 2023, the shift to private assets is now more apparent as it more than doubled, going from 20 to 42% of the total fund, which puts it at approximately 31 billion. And if you compare that to 2003, this allocation increased by almost 8 times. And also, it's larger than the total fund as of that year. And the reason why we did this, as Mike mentioned just a moment ago, LACERA's challenge, which is to meet its expected return, coupled with a maturing plan. So LACERA began to allocate more to private assets to increase the probability of meeting return expectations. Going back to the 2023 pie chart, you can see that there were finer slices across public and private markets, and new investments that were introduced in private, such as infrastructure, natural resources, commodities, liquid credit, and so on. This improved the fund's total risk profile. And with enhanced systems, we obtained more granularity into the fund, which helped improve diversification. And the reorganization of the asset classes enhanced the implementation of the fund, which now brings us to the functional framework construct. So going to the next slide, we can see the mapping from classical to functional framework. And back then, under the classical framework, each asset class was its own category. And under that construct, you had a growth risk across various asset classes in US equity, non-US equity, private equity, non-core real estate, and hedge funds, and they each resided in their own category. It was in 2018 when the strategic asset allocation shifted to the functional framework. And essentially what was done is asset classes with similar risk-return characteristics were grouped together. Now, I wasn't here personally to witness firsthand this migration from classical to functional framework, but this transition was a huge undertaking, and the resulting implications were even bigger. Streamlining assets into one category was essential to help us measure focus risk of the portfolio. And why is that? Yes, the pension has gotten larger, and that's clear on the surface. But as we heard from Mike, when faced with different investment environments and the shrinking active to retiree ratio, it is paramount to understand the risk-return nature of the overall portfolio. And refining the categories became increasingly helpful so that we can be even more intentional in our decisions. So let's move on to the next slide, which provides an example of the classic asset types and their mapping into the functional framework. Here we can see the different components that fed into the credit portfolio. On the left side, we see elements from fixed income, private equity, real estate, and hedge funds. And all these investments with similar credit risk characteristics existed within their respective group. And as an investor, one recognizes that it makes sense to group these together. And why is that? Well, it's clear from a risk return standpoint, as I just mentioned, but there was a realization that additional benefits could be made to align processes and procedures across the asset classes. With inconsistent processes, it was clear to pull them together to optimize the investment model by aligning things like due diligence process and procedures and fee and investment structures. The consequence of applying a consistent standard, as you can imagine, is a positive one, which was improvements in diligence and efficiency. When we pulled these all together, it amounted to a significant $5 billion into the credit portfolio at that time. And in terms of these improvements, not only did it happen within the credit portfolio, but also within the other functional categories. Additionally, the credit team was formed with the genesis of the credit portfolio. So that's an example of the evolution of the within the investment staff.
Migdalia, before you leave this slide, can you tell me a little bit about how obviously you're creating one acknowledgement that all of these have credit-like elements to them, but they also have differing liquidity levels, differing structures that they're invested in. How are you accounting for that when you sort of think about the functional asset, that evolution currently? And anybody can answer this question, doesn't have to be Migdalia.
Good morning, Chair Sanchez and trustees, if I may.
Yes.
I think this is key that Migdalia brought up. I work on in the credit and risk mitigation team.
Mm-hmm.
I think this was huge in identifying the various structures and how we want to structure our credit investments going forward.
Mm-hmm.
We have in our structure reviews, we identify certain structures such as the single investor structure, the dedicated managed account structure.
Mm-hmm.
And for some of these investments that have come in from private equity,
Mm-hmm.
real estate, or even hedge funds, they were in structures that were not as intentional to get the true kind of credit risk exposure that we want.
Mm-hmm.
And so for some of these legacy holdings that have come over, which we've identified them as legacy holdings through prior board approved structure reviews, we're letting those structures wind down naturally.
Mm-hmm.
And then on a go forward, we're establishing those credit vehicles that fit the objectives that we have.
Okay, thank you. Okay.
Thanks, Kwok. So now we're going to pivot to the next slide where we show how we showcase the evolution of the portfolio. So as we went through the changes of the fund, or the changes that the fund has undergone, there were categories that were making themselves apparent on how to organize this body of work. And beginning with asset allocation, this highlights changes to the strategic allocation and asset class additions, portfolio structure, which includes things like hedging programs, investment structures for different asset classes, governance, culture, and staffing. Some examples of what was noted were the evolution of internal committees, the changes in organization of the investment staff, and we highlight board committees. And then finally, operations, which not only spotlights back office, but also middle office operational changes. And many, if not all these changes have resulted in enabling the fund to go in the direction it has thus far. And each of these tie into LACERA's strategic initiatives with board's oversight, all aligning with the overall mission of the fund. So now let's get ready for the next slide because it has a lot to take in.
Wow. Yeah, I saw this one last night. I was like, ooh, that's 6-point font.
So I'm stealing from, Esme was a part of the team here, and she called this our quilt. And so I present to you our 20-year evolution quilt. This was our attempt to synthesize all those changes onto one piece of paper. We show each of the different categories we just went over together and the notable highlights. It's clear a lot has happened over these last 20 years, and we know that not everything is on here. We won't touch on each one. And in a short moment, we're going to highlight a few from each category.
I think it would take 20 years.
I think you're right. Something else we want to highlight during this 20-year evolution is at the very top. So if we all go there for just a moment, you see a timeline beginning from 2003 to present day 2023. And putting the endpoints aside, each year shown represents when LACERA reached an asset milestone. Now the line is not to scale, I want to point that out, but what is fascinating to see is when these asset milestones were reached each time. Going from 30 to 40 billion took about 3 years. Going from 40 to 50 billion took 10 years, which includes the global financial crisis during that period. Going from 50 to 60 billion took 2 years, and going from 60 to 70 billion took another 2. And Mike earlier talked about what would happen by losing 10% today versus losing 10% 10 years from today. And the period between the 40 and 50 billion resonates with that comparison as markets lost over 10% during the global financial crisis. Mm-hmm. So, hearing this, we go back to the question of why the evolution of the portfolio. And it's exactly for events like this where the portfolio has been structured to reduce the probability of large losses. Mm-hmm. So the next few slides highlight some of the changes for each category in the 20-year evolution, and Kwok will take us through those highlights.
Thank you, Migdalia. As Trustee Sanchez mentioned, it would take 20 years to go over the quilt. So we'll attempt to highlight a few in each one of those categories, and we'll start with asset allocation. As Migdalia has already shown, the portfolio composition has changed a lot over the past couple of decades. In the mid-2000s, public equities made up 55% of the total fund. Today, we've reduced that exposure to 32%. And between those 2 points, we've added asset categories such as hedge funds, bank loans, illiquid credit, infrastructure, natural resources, and we've increased our allocation to private equity. While these additions have undoubtedly added complexity, they were added as a result of multiple board-approved strategic asset allocation studies that were intended to address the challenges that Mike talked about earlier in the presentation regarding the decreasing expected return environment and increasing plan liabilities that LACERA faces. As LACERA embarks on this upcoming strategic asset allocation study, it'll be exciting to see what evolution this will bring, especially with some of the comments that we heard yesterday during the macro discussion regarding income is back. Next slide, please. So beyond strategic asset allocation, LACERA continues to redefine the way the portfolio is implemented. This highlights some of the efforts which are all intended to optimize outcomes so that the plan could meet or exceed LACERA's actuarial hurdle. Going back all the way to the early 2000s, LACERA expanded the Emerging Manager Program to include private equity after already having one in public equities. And over the years, the board has approved and further expanded the Emerging Manager Program to other asset categories, such as hedge funds, illiquid credit, and real assets. This has benefited the total fund with the niche and diversifying exposures that these managers can provide. This slide also highlights how LACERA has evolved to squeeze the most juice out of LACERA's assets via investment structuring. For example, in 2019, LACERA transitioned approximately $13 billion of its public equity assets that were invested in commingled funds into separately managed accounts. This restructuring allowed LACERA to negotiate more favorable fees, take in more share of the securities lending revenue, have more control over the tax reclaims, which is a source of outperformance in our global equity index account, and vote proxies that are aligned with board principles. In 2019, LACERA also standardized the format and frequency in which asset category structure reviews are being done. This has helped ensure that implementation decisions and actions align with investment beliefs, investment policy objectives, and strategic initiatives outlined in the annual work plan. These structure reviews have led to right-sized portfolios where we have added diversification where needed and reduced exposure where we were over-diversified. Yesterday, during that macro discussion, there were comments made about being tactical. Structure reviews have led to innovations that have allowed LACERA to be tactical while staying true to our policy targets. These examples include our internally managed co-investment and secondaries program, which started in private equity and then now expanded to credit and real assets, and also establishing springing mandates that allow our investment managers to call capital during opportune times. Finally, I'll highlight the cash overlay program. This has helped manage total fund risks by ensuring that policy targets are adhered to, while also adding nearly 400 million in gains since its inception by efficiently utilizing excess cash. Next slide, please. This slide highlights LACERA's governance and culture and staffing evolutions. In the early 2000s, the Board of Investments had 2 meetings per month, which by the end of the 2010s was reduced to one per month.
I would die.
In 2017, the board adopted the committee structure where subgroups of the board would flush out items before items went to the full board. This is the structure that we have today. And as we heard during yesterday's governance discussion, this was discussed by the trustees. With regards to staffing, the investment team is approximately twice the size of what it was during the 2000s and is now equipped with a dedicated portfolio analytics function and a dedicated corporate governance function, all of which have been accretive given the higher demands of a more complex portfolio. And finally, the board's adoption of LACERA's strategic initiatives and the TIDE initiative has contributed across multiple dimensions, which can lead to improved outcomes. Next slide, please. This page highlights many of the enhancements to the pipes and plumbing that has allowed LACERA to manage the portfolio more effectively. For example, in 2006, the total funds returns started being calculated by an independent custodian. In 2015, we established a fee validation process. In the early 2020s, we onboarded a new total fund risk system, and we continue to add data analytics tools. These upgrades have increased our ability to manage an increasingly complex portfolio. In 2019, we transitioned from a monthly to a daily performance close of the books, and John Grable talked about this yesterday. Why was this so critical? It allowed us to manage liquidity much more effectively. As Magdalia has shown, the portfolio has evolved to have more private market, less liquid exposure, having daily transparency on the public market liquid side became that much more important. Lastly, we continue to tailor and standardize our due diligence efforts, incorporating ESG and DEI risk factors into our underwriting standards, establishing manager scorecards that we update each quarter, and fine-tuning our internal investment committee processes via the efforts of a working group, as we heard from that group last month, are examples of how we strive from allocator towards best-in-class investor. Next slide, please. Over the years as an organization, we have lots of experiences and lots of data points. We like to improve on what we do. On this slide, at the top row underneath each category title highlights a few things that we've learned. And the 4 tiles underneath that show what we've done to improve on those learnings. After highlighting some examples through the chair, we'd like to invite trustees at the end of the slide to chime in if there are any key lessons that are not on this page, or even if there were any evolutions that we didn't highlight in the prior pages. So starting from left to right, understanding that asset allocation explains approximately 90% of a portfolio's risks and returns, transitioning the portfolio from a classical to functional framework was so critical, as Magdalia alluded to. It allowed us to fine-tune and optimize the portfolio to get us to the right diversification mix, and then apply our strategic initiatives to that implementation. Within portfolio structure, we learned that we need to be intentional on how we structure our investments. Earlier, we gave an example in public equities where we were invested in commingled funds, but needed to be in a separate account to extract the full benefits of our invested capital. In other cases, like in real estate, Jim Rice talked about this in the prior slide, and Trustee Sanchez did too. We were invested in separate accounts where we learned that being invested in a commingled fund would have led to better diversification and potentially higher risk-adjusted returns. Portfolio structure matters. We expect that via our structure reviews, we will continue analyzing optimal structures for each one of our investments. Within governance, culture, and staffing, we learned that the best outcomes come from having the right processes and resources. In recent years, we overhauled LACERA's investment policy and procedure documents to reduce complexity and overlap. In some cases, LACERA had existing policies that were in conflict. We took a principles-based approach in updating those policies, which helped reduce that policy conflict. We then redrafted procedures to align with those policies. The updates made to date have helped streamline our investment processes. And as some trustees mentioned in yesterday's governance discussion, there may be opportunities to review certain policies to further reduce some of that policy conflict. With regards to operations, we learned that better transparency in all facets of our investments, including performance, fees, and risk exposures, equates to better insights and ongoing diligence. We have enhanced our tools and elevated our underwriting standards in multiple dimensions. These changes have been in response to an evolving portfolio, but also in striving to be best in class. So here we wanted to pause to see if there was, and open it up to the trustees to see if there's anything we missed.
Okay, we'll take a pause here, and I'll start the conversation. I think the first thing that I would note is that it is very clear that every single one of these, efforts have been accretive to the portfolio, and you can see that actually through the performance. I think the thing that for me is very important, and for us as a board, as we're sort of contemplating how we go forward, we always want to ensure that these processes are codified and are not negotiable and not dependent on the people that happen to be here today. Policies, I always believe, should be written such that the responsibilities and requirements are there for posterity, and that we as a board then would sign off on those and have the confidence that it doesn't matter who the board members are and it doesn't matter who the staff people are, that the requirements we have are bound. And what I love about what we've done is that I think we've done a very good job of establishing great policies. And I want to make sure that we kind of put whatever enforcement meat behind, enforcement muscle behind that we ensure that no matter what happens, whoever's sitting in the role, that they have to abide by at least a procedure we know works. And that if we want to make changes to those procedures later, that it's a deliberate effort, a deliberate decision, I should say. So that's my thought here, I think, as we're contemplating how to go forward and how to set up all of the safeguards that we need as an organization to be able to establish not only trust, but also to some degree a trustless system, which is one that is not dependent on personalities and individuals, but is dependent on a system that works. I think that is, the element, and it's, I think, effectively already there. So I don't want to suggest that we have so much more work to do, but simply that's an element of how we, present these things as, things that we are making commitments to. And the other thing I don't want to do is bind us so tightly that we cannot experiment later. So that's the other thing that I would kind of make sure that we understand, is that there are things that we commit to, there are things that we're trying and maybe on a trial basis, and there are things that, and those trial things are that we know what they are. And so I think that's also functionally and procedurally important for, like I said, establishing that trustless system. Mr. Santos.
Yes, thank you. Thank you for the presentation. For me, this is a wonderful review, because I've been part of every single decision, every single change that's made here. So where it works, I take credit for it. When it failed, I was absent. But I just want to say that, change is difficult. Just to give an example, hedge funds. When we decided to begin the discussions and evaluation of this new strategy at the time, hedge funds. It took us, I don't know, perhaps Bachi is here who can correct me if I'm wrong, but it took like a couple of years. I remembered a debate between a general consultant and a CIO at the time, where one individual, the CIO, was believed in hedge funds, and I don't remember which one was it, but I don't remember if it was the consultant who suggested that we go into hedge funds, and the CIO. But anyway, there was a dispute, and it was an offsite. And it was a wonderful debate that took place. But even though after that debate took place, there's still reluctance of my colleagues to look at hedge funds. And it took many, including myself, because I'm a criminal lawyer, I'm not an investment officer. So I was terrified, because there were groups telling me hedge funds are evil. Why don't you just take the money and go to Las Vegas? You'll probably do better. And on the other hand, you were listening to other people that thought it was a good idea. I personally went to school for that and came back from Wharton convinced that hedge funds, if implemented properly, it was a good strategy, especially as a risk mitigation. So that's just one example. The changes of the 2 meetings per month. In those days, the board will interview every single manager. The staff will make a recommendation of 3. Pick one of them, and I think they call it a
beauty contests.
And I was very naive at the time, that I thought that by spending 5-10 minutes with a manager, it allowed me to select the best manager. It's not true, right? So that it has taken us a long time to be able to do away from the board desire to interview the managers. And part of it, I think, in credit to the current staff and Mr. Grable, is how the current CIO and staff takes the time to educate us and explain the processes. It's very important what we heard in the past few days about the investment committees, both from the consultant as well as how the staff operates. That is something that is basic, and that had we all had that information at the time we came on board, it would have been a lot easier. A real estate portfolio, it was the same situation. I wasn't happy with the returns, but my colleagues thought that we were doing the best, that the portfolio was performing the best. And it went on for years. And I think I calculated, take credit for that, that we potentially lost $1 billion or so because we were reluctant to make the changes, but we were able to make the changes. And now we try to take this huge ship and tilt it around, and it takes forever. So I just say that because we still have some decisions that we have to make that will improve how we operate. And I know it's difficult. Change is always difficult, but we need to rise above all that and evaluate, where we've been, which I think this is excellent, where we are, and where do we want to take this portfolio, especially since we are coming up with $100 billion in a matter of few years. One of them, in my view, is providing the CIO with discretion to invest. We need to be nimble. We need to be able to rely on the staff and the processes that have been eloquently explained in the past a few days, and of course, some of the meetings that we have had in the past, where the staff review the processes of how they go about to making recommendations to this board, and also the consultants. And I think it's important that we look at that. And again, change is difficult. I've been part of that difficult piece, but I believe that after all these years and seeing how robust the processes that we have, the checks and balances that we have, I feel good. And as everybody knows, I'm getting ready to retire. I really feel that. I told my wife that, honey, I feel good. I'll be able to sleep good at night because I know the work that is being done. Because my wife is always saying, is there going to be enough money for us? You retire, hurry up and retire, because I'm not sure if there's going to be enough money there. And it's easy for me to explain to her. In fact, last night we had a discussion about this, that I feel really confident. I can sleep good at night as a retiree because I don't have to worry about where my paycheck will come from. So I implore my colleagues to be open-minded and look at some of the proposed changes that some of us are trying to suggest, again, for the benefit of the organization and to streamline the processes that are so important. So please approach this with an open mind, and we will be able to get to 100 billion in no time without any major obstacles.
Thank you, Mr. Santos. That was impassioned. Ms. Gray.
Thank you. First of all, as you all know, I'm not on the Board of Investments. I'm on the Board of Retirement. However, because I'm very involved with SACRS, I keep up a lot with what LACERA is doing investment-wise, because across the 20 systems, county systems in California, which SACRS organizes, they look at LACERA as the big dogs. We are it. We are the example for the state. What I want to tell staff is that thank you so much for going through the evolution. But the biggest evolution that I've seen is to listen to Mr. Santos Because I have heard him for the past 12 years taking control, the board taking control of everything from a manager selection, investments, where we're going to allocate our assets. And now I'm listening to him relinquish control to a very trusted team, a very trusted CIO. And this was very important for me to see and to hear the evolution that I can share with other systems in the state of California. So thank you so much.
Thank you.
Thank you.
Thank you, Ms. Gray. Mr. Yu?
I just had a couple of questions on some of the slides, if that's okay.
Yeah.
On slide number 8, the active to a retiree ratio, it projects like in 2030, it pretty much flatlines at 100%. Why does it flatline? Or is it just, they didn't want to project that far?
So I don't want to speak on behalf of our actuaries. This is a chart from Milliman. And so these are the projections going forward. I think current day it's shown to decrease, but as far as why it flatlines, I maybe we can get back to you on that.
Because I'm wondering if it will ever go the opposite,
Theoretically, as long as you are hiring roughly the same amount as are retiring, you can maintain. What happens is if for some reason your services are no longer as necessary, that you start to have fewer and fewer people that are kind of hired into the system and more people that are retired relative to those, that's when you get into a real problem.
Right.
And this has to assume that we remain flat, that we as a population relative, that we are not going to be in that position. That has to be this assumption, otherwise it wouldn't flatline.
Yeah.
There's just one more thing on that, is that LA County is also going through the same situation that we have here, the great resignation or lack of people willing to work. There's a huge shortage of lawyers, doctors, CPAs. I can just go on, and that's why you see the active population decreasing. And I know the Milliman told us yesterday that there was also a high rate of deaths during the COVID-19. We all suffering in the county because those of us who are still working have to do double work, but that's just the reality. We cannot hire.
Yeah, it would be good to know because I'm actually flatline is fine. I'm just wondering, could it go negative? Because it's exactly what you just all said. I know minus COVID, but life expectancy is going higher and higher. So there's going to be a lot more retirees. And if there is less hiring, then can it go the other way, right? Because that would affect projections. But I don't know. Since it flatlines, I guess that's better than going negative. And then the second chart right next to it, can you explain the analysis above shows LACERA's portfolio lost 10% 10 years later versus 10% today. Can you re-explain that one more time? I know you guys explained it, but can you explain that one more time? What that means?
Yeah, you're talking about the chart on the right.
Yeah, the one on the right.
Yep. So what it shows is the employer contribution on the y-axis on the left side. So if it shows that if we lose 10% today, and the yellow shows that if we lose 10% 10 years later, the latter would result in being underfunded by 9%, as opposed to being fully funded at the end of the 25-year period.
Right.
And part of the reason is because you don't have enough years to compound that back.
Okay.
So when you take a hit right before retirement and then you crystallize that loss, you're hosed, to use a technical term.
Okay, I get it. Yeah. And then next real quick question on slide 9. The difference between 2013 and 2023. I know there was more categories. Is in 2013 the non-US equity, does that include global equities in there?
Yes.
Okay. So is it safe to assume that from 2013 to 2023 we invested more in global equities, right? Because non-US equities was 26%, and it's 33% in 2023.
So global equity encompasses both domestic and non-US equity. So in terms of, can you repeat your question?
Yeah, so and actually that's my second question. So when you say global equity, is it US firms that are international also goes into global equities, or
It's US and non-US stocks, correct, combined.
Yeah,
That's
so if you take 2023, the global equities is 33%, but if you combine the domestic equities and non-US equities in 2013, that was like 51%. So that global equities portion has gone down dramatically.
And just and thank you for bringing that up, because these were the classifications under the classical framework. And when it changed over to the functional framework, it's when domestic, which is US stocks, and non-US equity came under the umbrella of global equity.
Okay. Okay. Yeah, that answers my question. Okay.
All right, Mr. Jones.
Yeah, related to this slide, unless presentation isn't done.
Yeah, the presentation's not done.
You guys are going to stick the landing as we talk about going forward. But should we anticipate, as we look at the transitions, how they're presented here, that as we grow towards 100, should we anticipate likewise a higher degree of our overall portfolio being in private assets? And can you talk a little bit about what we as a board should anticipate a future ratio of public to private as we get to best in class investor at that point? So it looks like John's at the mic.
Yeah. The answer is probably not. I think that this is the whole concept of fixed income being that much more attractive today, that the environment, the next 5 years may be different than the last 20. Well, they'll certainly be different. But at some point, and it's part of Makita's strategic asset allocation analysis, they look at liquidity and they look at the liability, and recognizing that we're a mature pension, at some point, illiquidity becomes a concern, just because you may have so much tied up in illiquid assets that you may have to prematurely liquidate your liquid assets, and you may be rebalancing inappropriately. So I think that
even at 100 billion, you know what I mean? So you'll still have.
I think it will be growing.
Yeah.
But I don't think that we're certainly not an endowment that's going to go to 80% illiquids. I think that it's probably reaching. I'd say that the pace of growth is definitely decelerating.
Okay.
Yeah. Thank you. Okay. Well, then I think with that, let's continue on and stick the landing.
If we can go to slide 19, please. Okay, so as of this point, we talked about many evolutionary changes that have occurred. And the question is, has it all been worth it? We think the answer is yes. Based on the data shown here, it's without a doubt yes. And hopefully some of the return metrics and risk metrics that I talk about can help address Trustee Patrick Jones, your question regarding risk-adjusted return metrics. So this slide shows the 10-year trailing performance of LACERA's total fund as of June 30th, 2023. And the high-level takeaway is that the total fund has been able to achieve higher returns while exhibiting less risk, addressing both of those challenges that LACERA has faced, as Mike talked about earlier in the presentation. If you look at the chart on the upper left, we show the growth of $100 over the past 10 years if you invested in the total fund. This is shown in the green line. If we compare that to investing in a passive 60/40 portfolio over the same period, shown in the black line, we see that the total fund has outperformed that growth by nearly 50%. The chart on the bottom left shows the historical drawdowns of the total fund, again shown in the green line, compared to the total fund's benchmark and a 60/40 portfolio. You'll see that in all periods, the total fund has experienced shallower drawdowns compared to the 60/40 and our benchmark. And to further show this, on the far right column of the table, we show in 2022, when the market was very challenged, the 60/40 portfolio drew down 16%, while the total funds drawdown was about a third of that. And so this really ties back to the discussion yesterday we had with the funding policy and trying to minimize the volatility in the employer's contribution rate. This really speaks to that. So this profile has resulted in a Sharpe ratio, which measures the risk versus return efficiency that is double that of the 60/40 portfolio. And so finally, we highlight LACERA compares, how LACERA compares to a peer universe of defined public plans. LACERA's 10-year returns ranks in the 5th percentile, with first being the highest, whereas the 60/40 portfolio ranks in the 95th percentile. So these results provide some data points that show how valuable these evolutionary changes have been, and LACERA's members have been the beneficiary.
We have a question.
Oh, sure.
Thank you. Sorry. On the peer universe percentile, do you know how many peers are in this ranking for the peer rankings for public defined benefit plans? It says we're 5th.
This is per Makita. This is per one of our
5th percentile.
Makita charts. This is for public defined benefit plans with assets 5 billion or greater. But as far as the number, I don't know. We
I don't have
to
it
get
off the
back
top
to
of
you.
my head, but I will get back to you before we end the session on what the peer
I was
number
just
is. It's a
I was-
robust
I
peer
was-
set. I
right.
think it's probably like 70 or 80, but I'm going to confirm it.
I think about 74.
Okay,
Yeah.
74.
Thank you.
And this is 5th percentile, right?
5th percentile, correct.
So they're 96% less than we are.
Right. And then my other question was the benchmark, the total fund benchmark, which now I'm just realizing these are the same benchmarks that we have in our investment report every month. Yeah.
Correct,
Okay,
yes.
gotcha.
Mhm.
Thank you.
Okay. Mr. Ryu, is that hand left over?
I just
Okay.
saw that too.
It's okay. Continue.
So in just closing out the slide, so these results provide some data points and how valuable these evolutionary changes have been. However, these results show a point or a period in time. We must continue to redefine ourselves and evolve to keep producing good results. We must continue responding to existing and new challenges going forward. And with that, I'll hand it back to Mike to discuss the future and close out the presentation.
Thank you.
Thanks, Kwok. So slide 20 covers how we look at the future. We're approaching 80 billion, and we're going to continue to grow. There's that 100 billion bouncing around, and that's coming soon. The information outline on this slide might look familiar to most of the trustees. The strategic initiatives and aspirations that have been outlined come from our board-approved 2023 work plan that was presented earlier this year in January. Highlighting some of the aspirations, we want to continue improving our due diligence efforts and optimize our internal investment committee processes. We want to be intentional and avoid uncompensated complexity. We want to be term makers as opposed to term takers. We want to be leaders in internal governance, ESG, and D&I initiatives. We want to continue cultivating that investor mindset that has helped us evolve to where we are today. We would like to pause here to see if the board might have any considerations to discuss now to further refine our aspirations that have been outlined.
Well, I wholeheartedly agree with all of these aspirations, and I think that's a lot of aspiration.
I mean, I think the only thing that I might add, and I think John has often says this, is that, the greatest leverage of the kind of returns and things that we see presented here is the quality of the people and the staff. So perhaps even making it explicit about the level of investment and kind of optimized workforce experience that everybody has as a part of the team there. Just really drawing that out. I know you do that through some of the cross-functional stuff. You do it through, I imagine the investment committee stuff has to be a really fun experience for people as well, giving them that perspective. But just, I know we're sensitive to it. It comes up almost every time during the board meetings about, oh, we got open positions, we got gap, and we got people doing things. But perhaps just making it even more explicit from an aspirational standpoint that, not only do we want best in class, we want to be a best in class investor, we want to develop best in class people, hire and retain those. So thanks.
And I think it's worth noting that the Board of Retirement in their operational strategic plan does highlight investing in people in their plan priorities, which is not the LACERA strategic plan, but the LACERA Board Retirement strategic plan. So, thank you.
This time I did raise it. This might be a good time to ask, Madam Chair, there was a lot of references from a lot of our more experienced board members about next steps, or Trustee Santos talking about there's going to be recommendations for some changes and procedures and all that. So when is that coming?
Well, so for the plan on that, we do have a peer review that is coming in Makita's at our next board meeting. We will do a peer review of how do our peers manage their plans. I think in concert with that, it probably would also make sense to think about, what we have in terms of process and procedure in place, and what would we need to enhance that if we wanted to make it ready to go forward. So I think that kind of a study might make some sense as well, as, not as any kind of a formal motion, but as preparation, so that, when we have that peer review, we will be ready to go. So just some thoughts for Mr. Grable, and also Mr. Rice. Because I think it would be a combined effort, and possibly even bring in Nossman on that.
So probably next meeting or the meeting after, because I know there was a lot of ideas that were generated in the various discussions that I think they're very common sense, and I think it'll be very helpful, especially for us newer board members.
Yeah, I mean, I think it's worth an exploration. If nobody's opposed to that, I think that would be the sort of takeaway to staff, in order to prepare us for having a real discussion that has things we can, pick at and change and improve and get somewhere.
I'd like some sort of formalized,
Okay.
to agendize that some time in the future.
We can agendize it for the next meeting.
I will support that, and
Yeah.
I will just add that the consultant and the CIO submit written proposed policies that we can review, and that way we have the opportunity to look at how those policies will be formulated, and be able to have some meaningful discussion at that point. And at the end, it could be adopted or rejected, whichever.
Is that
the
enough
wisdom.
time to draft? Is that maybe one more meeting? Okay, fine. So let's do November.
Yeah,
November
in the
meeting?
governance work plan, we had the peer review, and then the November meeting was when we were going to prepare recommendations, because I think that the peer
Okay,
review,
so November.
as part of it, we'll be pulling out excerpts from other policies, practices,
So ideas and
procedures.
thoughts. Got
Yeah,
it.
so then we'll have a little bit of a framework to still review and discuss some of those different things. And then LACERA's team will have the opportunity to sort of refine the thinking and integrate any of that into recommended policy action.
And also, I want to make it clear that when I talk about these ideas that were brought up, it's less about the investment side, because I know that it's more intensive, and I want to give our CIO more time if there is any changes in investment policy. I'm talking more about the governance, like our board side. So it's maybe more like our CEO, Mr. Santos, on, like we talked about travel, making notes on, for other board members to know. I mean, stuff like that. So
Okay.
things that's more for us, which is
Internal governance follow-up.
yes,
Got it.
is
Okay.
more. I think is easily more for us to vet and pass versus I don't want to. I mean, I'm very much open to changes in any kind of investment policy, but I think that should be more methodically spaced out.
Mr. Rice, what would be the kind of appropriate process for us to sort of bring forward? We had a lot of ideas that obviously came from our conversations about the various policies and how we conduct ourselves as a board. Does it make sense to maybe have a kind of review with Ashley Dunning, just a thought, and set of recommendations to how to formalize that into either a roadmap for how to tackle these issues?
A lot of this is going to follow from the Makita process for which you already have a calendar.
Got it. Okay, so then we will make it on the back of the Makita,
yes,
Makita presentation.
I think that's best, and I do agree that Ashley Dunning should be involved. She's already made some comments in the process, actually, of looking at the funding policy and tying that into the JOG-C charter and the BOI charter. We separately have the process that's been going on with regard to the revision of the JOG-C charter, which also requires BOI and BOR charter changes. So there are a lot of threads that I think need to be woven together. I don't think all that's could be completed by November, but if we use Makita's process as kind of the jumping off point, that might allow for more methodical process.
Maybe we can build a roadmap.
Yes.
And the Klausner, the law firm, is the one that worked with us at the JOG-C. So I will suggest that they be involved.
Yes, we will bring in all the fiduciary resources, both firms.
All right, so we have a plan to make a plan in proper government fashion. Everybody comfortable with that? We have a plan to make a plan. All right. So do we have any concluding thoughts, remarks?
Yes,
closing?
we do. If we can please go to slide 21.
Look at me, I keep messing your landing up.
So in conclusion, LACERA's portfolio has been proactive and intentional to meet the obligations to our members. The work so far and the continued efforts are progressively taking LACERA from an allocator towards best-in-class investor. Thank you for your time, and this concludes our presentation.
Thank you so much. That was an excellent presentation. Thank you. Okay. So this draws us to the conclusion of our on-site, off-site. I want to thank Mr. Grable and staff for putting together a really, really excellent agenda. I think everyone feels like we've come away knowing a lot more than we did when we came in about our portfolio and how we work. I'd like to propose, if it is okay, Mr. Grable, do you have any closing comments? Do you want to close with? I'll give you one landing.
I can do it, Madam Chair, in the CIO report during the board meeting.
Okay. So I'd like to propose, since it's not yet noon, if we could do the open portion of the meeting now. It's not a long meeting, not as long as far as I can tell, and then we can take a break and go into executive session while people go to lunch. All right. So with that,
recording stopped.
Oh, we have to reset.
Recording in progress.
Okay, it is 11:39, and I hereby call this meeting of the Board of Investments to order. Do we have to take another roll call?
No, just one.
Okay. You are all present and accounted for. So we will begin. If you are not logged into the Prime Viewer, make sure you're logged in so you can vote. We will begin with the approval of the minutes. Yes? You're what?
Okay, I'll just call on you,
Okay.
and I'll have somebody come turn it on.
Gotcha.
Kyle, can you help Mr. Santos real quick? Okay.
Yeah, we are all voting. Mr. Santos will
Okay, let's
Linda
just,
will do.
okay, we need a motion in a second. It's fine, motion in a second.
Okay, do we have a motion?
Okay, a second?
Second.
Okay, Mr. Rue seconded. Ms. Ginsburg?
Yes.
Okay, Mr. Santos?
Aye.
Okay, Mr. Green?
Aye.
Mrs. Jones?
Aye.
Mr. Jones? And Mr. Rue?
Aye.
And Chair Sanchez?
Aye.
Okay, the motion passes unanimously.
Okay, thank you. Moving on to the Chief Investment Officer's report.
Thank you, Madam Chair, trustees, colleagues, guests. A few comments after what was a terrific onsite, offsite, offsite, onsite, onsite, offsite. I'm really heartened because I think that this, the engagement level really was far in excess, I think, of any expectations. And I think a real, moment to pause and thank, trustees for really engaging and advancing the discussion. So thank you. So I'll start with that. As it relates to, a theme, I think that the theme from the 6 sessions is really porting what we've done well with a learning mindset that always, once again, is focused on being better at our craft tomorrow. So I think that learning lessons in a constructive way and focusing on the future really was a theme, and it's something that I have high confidence that will continue to do well. I think that we will port those lessons to the new circumstances that were identified, be it in the macro environment. There was a very engaging discussion. The discussion on governance, I think, is the first time in a LACERA offsite that I've seen something extended to the extent that it was, which was fantastic. Capital market assumptions, I know that those will continue over the next, 8 months or so as we go into our new strategic asset allocation. The funding discussion about a funding policy that is overdue for an update, and I know that the executive office, Mr. Kryman, will certainly shepherd that process. The discussion this morning about risks and how they vary by investment categories, and how the board should take comfort in the separate and independent processes as it relates to LACERA and our advisors. And really framing, in that last session through the lens of our evolution as an organization, and not evolving for the sake of change, but evolving because change was necessary. And I think that's really important. I would say that another theme that came through for me was team. I think that the offsite was a team effort. And the members of the team, we often talk about the team, the investment team, but I would say that the team board was here, and the critical part of really making the offsite productive. So thank you again. The investment team for months upon months of work as it relates to this, but it takes the LACERA village. And that village includes the legal office, FASD, the executive office, systems. Outside of our village were some outside speakers, our advisors. And smiling at me right now is Linda, the executive office, as well as to my right with Alex, who I know is producing like a TV show or something over there. He's going to call on the next contestant on The Price is Right. So thank you, everyone, for what was really fantastic. If we could turn to slide 8. So now I'll go from that into the CIO report. And I'll stop here and pause a bit on what to watch under stewardship and ESG-related developments. And here we mentioned the SEC and the private fund rules that came out a week or so ago. They're significant, there's a hot link on this near the bottom to a comment letter that LACERA that we wrote based upon the board's principles, on the proposed rules. I think that there are lots of people that commented, but I think that I would encourage everyone that may be new to the board to look at that. I think that our engagement letters, my name's on them, but the team's the one that writes them. They're fantastic. And it's something that proud to have my name on. And I think that it accurately reflects LACERA kind of in that arc from allocator to best-in-class investor. I would say that our comment letters are best in class. And it's something that I'm quite proud of.
If I could interrupt you there, actually, can I make a comment there? When I took my HBS corporate governance program, one of the case studies was a case study of poor share class structure, and it was SNAP. And the comment letter that was highlighted was one that we had signed as an organization that is a part of that HBS case study. So I was actually quite puffed up at that moment.
Yeah. Me too. Now I'm smiling, even more so than I was before. Beyond and maybe more important than our comment letter is these rules are significant. And we talk a lot about private markets, and in the risk discussion, there was a big discussion about our legal rights and how we negotiate those legal rights, and they are all manifested through a side letter. My concern, and it's early days in terms of the interpretation rulings and the effects of the private fund rules, is that there's a potential for the chilling of our ability to negotiate our rights as fiduciaries with various general partners. And it's something that I know that their lawsuits have been filed by GPs. Our issues are different than their issues, but this is a space that we need to watch. It's imperative for us to watch. I know that we've had both from an investment and a legal perspective calls with different advisors on this, but it's something that I'm very concerned about. And I'll say this at the most basic way I can is we have index funds, which are not commodities. Technology has commoditized them, but we pay less than a basis point for an index fund. We should not have a greater ability to negotiate terms for index funds than we do for private equity funds, where we lock up capital for a decade and pay all in maybe 500 basis points. I just find it almost outrageous that our rights potentially, our fiduciary duties on behalf of our members can be curtailed, and that's not the intention, but that may be the outcome of the SEC's rules. And once again, maybe I'm going off my script here, but it's something I'm concerned about, and it's a space that's really important to me to watch. So if we can turn to the next page, and maybe I'll pause and just let that settle in and get my blood pressure down a little bit, which is July, total fund summary. July was a positive month. August, less so. The ACWI, which is our equity benchmark, was down about 3%. The fund as a whole was up net during July, 1.6%. Great way to start the fiscal year. It isn't that now. The fund, I don't know if we top ticked, but our market value, our NAV, was 74.6 billion as of the end of July. The way I round, it's 75, and if we round to the nearest 10 billion, maybe we're at 80 billion.
I do the same thing.
Yeah, but actually, if we include OPEB, total funds under management here are getting close to 80 billion. On this slide, it's something we do show, and it shows trend is the Sharpe ratio. I know Mr. Jones asked during the risk discussion about, do we measure kind of a risk-adjusted returns? It's something that is in various slides here and will also be discussed during the performance review later this morning. And I'll talk a bit about our performance review book in a minute. Cash is a little bit high as of the end of July, but we knew, because we do a rolling 90-day cash forecast, cash forecast that there was going to be a lot of capital calls early in August. But we always like to keep, 3 months of cash on hand. And if we turn to the next page, which shows net performance for both the fund and OPEB over various time periods, at the bottom, OPEB was up 2.5% for the month, 3.2 billion net. And, I mentioned that after or later on in reports, there'll be a total fund and OPEB performance books, that discussion for the fiscal year. And maybe this is kind of linking back to the offsite a little bit, is that our quarterly performance book is another example of our evolution. It wasn't mentioned in that last presentation, was probably on Esme's quilt, but there is so much more detail in these books. There's so much detail about public markets, about every manager. Private markets, when we originally used to do these books, it excluded private markets. And now, we would do private markets once a year. This book that we do quarterly now includes private markets. We have a manager scorecard in there that has so much detail, has itself gone under a tremendous evolution. And I encourage everyone to spend time really going through that. There's fee data. There's data as it relates to ESG. That's something that we didn't collect and share and publish years ago. There's a risk analysis, which once again goes back to Mr. Jones's question. And this book, really importantly, is top down and bottom up. And maybe more importantly, it goes back to Ms. Jones' comments from yesterday, which is checks and balances, in that staff produces a book and then there's a separate book that comes from Akita, from the consultant. So
nobody can cook it.
No one's cooking the books, and several of us sign our financial statements every year towards that effect, so, and this is our performance books, but this is something that we take tremendous pride in improving, not just the presentation, but the quality of the information and the reconciliation process. So it is night and day different about maybe this evolution's revolution in terms of how much these books have changed. And then maybe the last slide in my long truncated remarks that I'll mention is the next slide, slide 11. There is a new addition to this page. There's a new chart on the bottom.
I like this chart.
This was a result of a question asked by the board chair last month. And
I feel heard.
And we did that the prior month where, Mr. Kelly asked a question about the U.S. debt. We added a chart about U.S. debt that's on there now, where this shows the growth of the fund as a whole over a 10-year period. We compare that growth to our policy benchmark and an actuarial return. So the growth, so on this chart, you see 113%, 101%, 97%. I can't read that last digit. I need a new prescription probably. But basically, this is showing that we're outperforming our actuarial target and our policy benchmark, which means that the active risk we're taking is being compensated, and that we're doing better than the assumptions that go into that actuarial framework. With that said, and there's a small footnote, I should probably expand it. This is not an actuarial analysis. We have to remember that we're 80-ish% funded, and that we call this excess returns. It's excess returns. It's not excess, because the assumption is that we will earn on average over time 7%. But I think that this should give the board some comfort that which we're doing collectively is working.
Thank you. And thank you for the chart.
And with that, Madam Chair, I'm happy to stand for any questions.
All right. Do we have any follow-up questions? Thank you for that chart. I appreciate it. Okay. Great. Then with that, moving on, for those of you who are visiting our boardroom today, Our member spotlight is an opportunity to continually remind ourselves why we do what we do. And this is effectively where the rubber meets the road. Mr. Popovich, take it away.
Thank you very much. Well, you took the words out of my mouth, but this is that time of the month when we recognize our members, and as the chair said, this is what it's all about. This is why we're here. This is why we put all this effort in. And so this month, we'll go to the next slide. We're going to recognize Magdalena Lopez, and she is a registered nurse in the Pediatrics Emergency Unit at the Harbor UCLA Medical Center. She is got 23 years of service. Will be thinking about retiring soon. She loves what she does. What she does is, and I'm going to read what her answer was to her notable contributions, because I think it's really important. Ms. Lopez manages pediatric emergencies and monitoring of critically ill patients, aiding the underserved and bridging communication gaps with her bilingual abilities. We are a multicultural city with people from all over the place, and I can't imagine anything more comforting at a time when you're going through, a difficult time than having somebody there that you can relate to and understands you and can speak to you.
Yeah.
So a big thank you to her for all the efforts that she does. She's not ready to retire yet. She will be soon, but when she does, she plans on continuing to learn about her profession. She's going to be devoted to her animals, her dog Sally, which is a poodle, which I love. I have 4 dogs, so one of them is a poodle. So thank you, Ms. Lopez, for everything that you do.
Thank you. Okay, moving on to the Chief Executive Officer's report.
Great. Thank you, Chair Sanchez and trustees. Good morning still. Got about 5 minutes.
Yeah.
Very brief report from me. I just wanted to make sure that you're all aware. I believe I've sent out a notice to all of the trustees about the unofficial results of the election. And so there were a couple of the trustee-elects that attended this board meeting. Nicole Mee, who's sitting to my left here, and Debbie Martin, who wasn't able to make it today, but she was here yesterday.
Yeah.
And I know that she's watching this virtually. So hello, Debbie. I did want to also mention that I did reach out to the Board of Retirement elect. Her name is Nancy Durazo.
3 women.
Yes, Nancy Durazo. And I spoke to her. So she works at Olive View Medical Center, and she helps with recruiting nurses. And so we're reaching out. We're going to start scheduling orientations for them as we move forward. And so we're waiting for the official results. We anticipate that the Board of Supervisors will make it official in October. Once that happens, we'll start scheduling the orientation. But in the meantime, we'll be providing them with just basic information about LACERA that's part of the public record. And so we'll try to answer all of their questions and get them up to speed. There are also going to be, the Board of Supervisors need to make 2 appointments in the Board of Retirement. They need to make 2 appointments for the Board of Investments. The 4th and the 5th district are up to make the appointments of the BOI. The 2nd and 3rd districts are up to make the appointments for the Board of Retirement. So I have reached out to those particular offices just to provide them with information, qualifications, so on and so forth, so that they can make a selection. I'm hopeful that they'll be doing that sometime in the very near future. And so we look forward to welcoming them on to the LACERA family as well. So I did want to mention that that the strategic plan, which is a report to your board, was approved by the Board of Retirement. The Board of Retirement strategic plan. There was also a mission, vision, values document that was also jointly reviewed and approved. And so we're presenting that to you all for for information purposes. I do want to let you know that as part of the strategic plan, the management team, the executive team are going to have a offsite just with the managers to talk about action plans, the developing of the execution, and trying to execute on the expectations of the Board of Retirement. I do want to highlight the fact that Mr. Grable and Mr. Perez, we had discussions with them, and there will be representatives from the board, from the investment staff at that particular event, because we think it's important that we are one LACERA, and we need to understand how we can support them in meeting your particular expectations of Mr. Grable and his investment team. And so we thought it would be best to combine that. And so we're looking forward to having the investment team there so that they could provide some valuable input. We're trying to build a work culture for everyone, not just the BOR folks, the administration side, but also for the investment side. And so we think it's important that we begin meeting jointly. So we know what your expectations are. Mr. Grable and I talk about it all the time. We know the expectations of the Board of Retirement. Now the job at hand for Mr. Grable and myself is to try to establish the standard that we need to meet moving forward. So expectations and standards are two very, very different things. And so I know that Mr. Grable's bar is incredibly high, and so mine is equally as high. And so we're going to make sure that that we develop something that's going to be durable, that's going to be long-lasting, and that's going to be impactful moving forward. In terms of hiring, Mr. Grable mentioned that Esme was promoted, and so congratulations to her. We're still in the process of trying to identify a senior investment officer for the real estate side, and then also for the Scott Drazel's governance and corporate
governance.
So we're in the process of working with him to try to identify the job skills that he needs, and we're actively trying to recruit individuals for those particular positions. And then the credit risk position also is something that we're working hard to achieve. We're still having some difficulty recruiting attorneys, both for the investment side as well as the benefit side. The salaries don't seem to be matching up with what is out in the marketplace. And so Mr. Rice, myself, and Mr. Grable have been talking about how we continue to support the operations through until we can find qualified candidates and select one or two. I believe there's 2 investment attorneys that we need and 2 benefits attorneys. So I'll pause there and be more than happy to answer any questions for you all.
Thank you.
Around the investment attorneys issue, you mentioned the salary gap between being able to get the person. Do we have as much flexibility in that particular department to kind of establish a compensation outside of the county structure, or are we back at that same kind of loggerhead where we're
at the same loggerhead, and we have to go through the county process as a result of the decision that was made by the as part of our first lawsuit.
Right.
And so we were told, Mr. Liu and myself were told that we have to follow the county process. That being said, we have a meeting with them on the 14th, which is tomorrow, to go over some of the items that we need. We're going to be talking about compensation levels for the attorneys, talking about them providing us with the positions that we requested in April on the pension side. And so it's been a difficult, when they say that we have to follow the county process, we're following it because it's been 6 months since our initial request for the additional positions, for example.
Madam Chair, would we be able to, in closed session, just put that thing on the agenda for a second, or no?
We cannot add to the closed session agenda because it has been agendized by Brown Act, but we can add it to a future agenda.
Okay.
It required public notice.
Yeah.
Oh, okay, gotcha. Just wanted to, because there's a, yeah, okay.
Okay. Any other comments?
Yeah, I have
Yes.
a comment. It's really sad what's going on with LA County because they haven't, as I mentioned earlier, they also having problems hiring attorneys. Our office is severely understaffed. The district attorney is severely understaffed, and for the LA County to try to keep the lid on the compensation level, just because it's just not working because my department is not able to hire attorneys, just like we have problems here. And it's just, I don't know what we need to do, just get the Court of Appeals to rule in the appeals that we have pending, but we cannot operate like that. And I don't know what to do, but we need to, perhaps colleagues who have relationships with the supervisors can express the views, because they need to understand that we cannot operate. And mentioned at one of the meetings that there was an article produced by NCPERS that talks about we need to, pension funds, public pension funds need to operate like businesses. We can no longer operate like government because obviously the sophistication and the level of money that we are responsible for, and that's what it takes. But somehow or another, we need to get the Board of Supervisors on board, or at least have the Board of Supervisors tell the CEO, the county CEO, this is the reality. So
right. So we're working on that. We'll see what happens tomorrow.
Okay. Yes, Mr. Green.
So it's not just about the hobbling of not being able to pay people for what they're worth, or recruitment in a but it's also deals with the ordinance position authorizations, right? And that the gatekeeper on that's the CEO. They can authorize the ordinance position authorization to happen regardless. I mean, that's in the county code. Can you elaborate on that?
So we provided the county CEO's office with the positions that were approved by the Board of Retirement and the Board of Investments back in April. And so usually what happens in the county is you provide the information and then they'll take a look at it, and inevitably there'll be a request for additional information, and then additional information, and then additional information. And so you come to a point where you finally just tell them, look, you have everything you need. You need to make a decision. And then we deal with the fact that they're on a regular rotation in terms of how many times they go to the Board of Supervisors in order to ask for ordinance positions. And it usually happens during budget time, or it happens during mid-year budget. So we keep pressing them, saying, look, we need these things now. So for example, we asked for 25 additional retirement benefit specialist positions because we wanted to recruit and we wanted to have a class to start this month in September or October. We can't do that now. So now what happens is it puts pressure on us because now we have to wait until after March, which is our busy season, right? Because it takes resources to train folks. And so it delays us. But the problem is that we can't seem to get a read on what information is required.
What's it going to take?
What's it going to take, right? How much more information do you need? What kind of information do you need? And it just depends on which analyst looks at it. So it's a moving target, which makes it incredibly frustrating for everyone
I'm
involved.
frustrated. I remember the meeting. We as a board, we authorized the overhire, so to speak.
Yes.
To prepare for that with a succession plan. it is, and correct me if I'm wrong, it's out of LACERA's budget. It's not out of the CEO's budget.
It's out of our budget.
Yeah.
Okay, so my point is that there's no loss. It sounds like it's I'm not going to do it, and that we've seen it in other departments, and it is a slinky effect that that is very hard to overcome when you have retirements, especially when there's a process, whether it's training or a promotional process internally or a new hire process. You're pushing chain uphill, and you can't overcome it, and it will grow and grow and grow. And I'm speaking specifically to some of the safety areas where there was no hiring for 3 years, and we still haven't recovered from it. And so I want to make an emphasis on this, that there's no reason why the CEO is not allowing for this additional ordinance position authorization, in my opinion.
They haven't told us no, right? What they're saying is they want us to justify it further. So we haven't gotten a definitive no. So, and I think it's important to point out that back in 2017, LACERA asked for a bunch of positions, right? Because we were planning for succession planning purposes. And one of the areas had to do with our legal division, that we needed higher level positions in order for us to make sure that we, number one, could retain some of the talent that we had now, so that we could retain them, and then start training individuals to become to step into those higher roles of responsibility. That didn't happen, and so they rejected that, and then that's where we got into the lawsuit issue, the independence issue. And so there's specific examples of how that decision that was vetoed by the Board of Supervisors has impacted our operations significantly. And so now, here we are. We can't succession plan. We don't have the positions that we need. We can't recruit critical positions, right? And so that is the challenge that we have. And that being said, we're also handcuffed by the civil service issues, right? So we're doing our best. They are, I don't want to say that they're responsive. They're responsive when my staff asks for things, right? Or when they're responsive because they're responding back to my staff when my staff calls them and says, where are we on this? And they say, well, we need more information.
I mean, there's coming out of COVID, reading the service reports and stuff, the ratings by membership and stuff, we've seen an increase, and that's due to the efforts of your office and everybody else. But there's a direct correlation between an understaffed workforce and work comp, for example, which further burdens staffing issues. I mean, the data is there, and if it's not addressed, and we have a training requirement, you have a training requirement to bring people up to speed, it's going to get away from us, and you won't catch up with it. And that's the emphasis that needs to be communicated.
Yeah.
That these aren't. I mean, it's everybody from Mr. Popowich's group to the investment group to the legal group. Everybody, it's going to burden and not be able to meet our mission statement.
Right.
And I don't know who's got to write the stern letter to whom, but I don't understand. It's not something that there's an impact to the county budget or anything. It sounds
right.
The reluctance to do the ordinance position authorization is beyond me. I have no idea why it's happening.
I think one last comment. The one thing that we have agreed to with the CEO's office is that we are starting to have regularly scheduled meetings between myself, Mr. Lugo, and the CEO, Chief Deputy, and the CEO.
Good.
And so we're trying to figure out how to get this through, because when I bring this up to to the chief deputy, he needs to look into it and try to figure out where the loggerhead is. And so we need to break through this. And then I think once it initially gets broken through, and then we decide on what information is needed, we'll be able to process these things a lot faster. But in the meantime, here we are.
What thought is that, if we are able to quantify the opportunity loss in terms of billions of dollars that we have lost as a consequence of not being able to be fully staffed and operate like we deem proper, I think that might be something that get them moving.
Yeah, I think it's difficult to quantify it because most of the positions that we really need are overhead, right? They're not really a revenue generating
But the investment staff-
organization like the investment side. But we'll see what
Just
we
an
can
idea.
do. Yeah,
Just an idea.
Okay. So I think I'm going to draw this conversation to a
thank you.
close. I think you have as many opinions on this as more. If you ask 10 people, you'll get 12 opinions. So thank you for your work on this. I am enheartened. I'm happy to hear that you are setting up that regular meeting. I think that will be important, that communication. I'm also very happy to hear that you will be including Mr. Grable and Mr. Perez in the executive offsite. I think that is key. Partnership is key. And what I learned in my listening tour was that, mixed messaging from board and the executive level are challenging. So we need to be unified as an organization. We need to be unified as a board.
Mm-hmm.
And so it's great to see that partnership continuing to, evolve and strengthen. So moving on, as a point of logistical point, now that we're getting into the consent and review, we do have limited capacity for seating downstairs in the lunch. So for those of you who would like to enjoy the performance book while eating lunch, we will not be offended if you go now so that we have enough seats for everyone when we conclude. So I'm just going to give everyone a perfect carte blanche to go and find some space for lunch and enjoy the rest of the agenda from downstairs. So with that, do we have any requests to pull any of the consent items forward? And if not, I will take a motion for the consent agenda.
Move approval.
I have a request.
Oh,
Yes.
sorry.
Yes, Ms. Jones.
I request to remove A, credit structure
To pull it. Yeah. So we'll pull it for conversation,
Yes.
for discussion.
Okay, but we can still vote. if
Yeah,
there's no
exactly.
changes.
So do you move the rest?
Absolutely, yes.
Second?
Chair,
Yes.
can I pull the item F for discussion?
Item F, the revised joint organizational governance committee. Yep.
Yes, please.
A and F have been pulled. Any other requests?
No.
Okay, do we have a seconder?
Second.
Okay. All right, we get to vote by video game.
Mr. Santos, are you logged in?
Yeah.
Okay, perfect. Okay.
You can do it.
It's frozen, right?
Yep.
It's frozen. Okay, so Ms. Ginsburg,
Yes.
Mr. Kelly. Oh wait, no, he's not here. Mr. Santos,
Yes.
Mr. Green,
Yes.
Mrs. Jones,
Yes.
Mr. Jones,
Aye.
Mr. Rue,
Yes.
and Ms. Sanchez.
Aye.
Okay, it passes unanimously.
Okay, super. So we'll start with item A, the credit structure review. Ms. Jones, you have questions?
Yes. Well, what I see for A is that we were giving an approval of some amendments to the credit risk review.
Mm-hmm.
And I'm okay with all of the changes, except for there's this mention, there is an amendment that delegates the manager selection authority for the CIO for this particular asset category.
Mm-hmm.
But I don't see any guidelines, any parameters It just says we're giving the CIO the authority. Is there a separate document that has the parameters for that?
Would it be the overall asset category guidelines?
Yeah, these are the guidelines actually that we've approved are the guidelines with which manager authority would exist.
Our understanding was that the recommendation was subject to two conditions. One, that manager due diligence continue to be just as robust as it is currently.
Mm-hmm.
And two, that reporting be just as thorough as it is currently.
Okay, and that was it.
So-
So there's nothing to the effect that what happens if that isn't done, or with most policies, there's parameters that say, well, if you're not meeting the requirement, this is going to be, I guess I'm a little confused because
Right, it was passed before we had this longer, robust discussion, obviously.
Right.
And I think one of the things that our discussion has to kind of include is a broader set of kind of how and where. This is consistent with other delegated authority that we have already. So right now, this is currently the practice, which is that these are the guidelines. The guidelines are established within the structure review. However, I recognize your concern, and that is why we're kind of looking at other language in other organizations to add to it. So I think right now we're operating under the assumption that we are going to bolster this in November. Okay. Any other questions? All right. Do we have a motion?
That already.
No, it's
You
not.
floated
Yeah,
it.
it was pulled.
Okay.
So do we have a motion for item A?
I move approval.
Thank you. Do we have a second? Thank you. Mr. Jones? Roll call.
Ms. Ginsburg?
Yes.
Mr. Santos?
Yes.
Mr. Green?
Aye.
Mrs. Jones?
No.
Mr. Jones?
Aye.
Mr. Rue?
Yes.
And Ms. Sanchez?
Yes.
Motion passes with 1 no.
Okay. Okay, item F, the revised JOG C charter.
Thank you, Madam Chair. I had some questions, and regrettably, I would have preferred to field these with staff, with legal. I understand my questions regarding some of the language. There's a removal of specific duties in the summary of the 2 board areas of responsibility. I believe it's under, and also under responsibilities. I understand the previous charter responsibilities is responsibilities of the JOGC, but it seems that Mr. Klausman's edit in language makes it more relating to the strategic plans of the BOR and BOI, and I'm a little lost here, and I'm not necessarily understanding why under this charter this is specifically for the duties and responsibilities of the JOGC, but then it goes to application of the BOR strategic plans as they relate to budgeting. Prior to that, it was just the strategic plan. And then that the JOGC was to provide guidance and development of a 3-year plan, which is now annual, whatnot, and specific duties, the shared responsibility budgeting duties for both boards. So that's my first question. And then further down in the document.
To the chair, Mr. Green, if you can direct us at which paragraph or page you're looking at?
Item 7 and 7.1 under responsibilities. After authority of the JOGC, I'm just confused. It seems contradictory. The language, we're talking about the responsibilities of the JOGC, but it shifts under responsibilities to application of it. Or prior.
I think I can explain.
Thank you.
There has been some discussion between the boards about how the organization's overall strategic planning process should take place. That those discussions are still underway, and the organization is not settled on how it wants to complete an organizational strategic plan, if at all. So we have a JOG-C, we have a BOR strategic plan, which has been approved, and then the Board of Investments performs its strategic planning exercises. Under the charter as it stands today, without these revisions, the JOG-C is in the middle of those separate board strategic planning efforts, and that is not a proper role for the JOG-C to engage in the separate responsibilities of the boards. What is a JOG-C responsibility appropriately is budgeting, because that's a joint board responsibility. So these changes, and these were drafted by Mr. Klausner because he had been asked by the board leadership and the boards more generally to do the drafting on this, is to clarify in this charter that the JOG-C's responsibility is only with respect to budgeting, but it incorporates a recognition, as is necessary, as Mr. Klausner explains here, for in the process of budgeting to consider what these separate strategic plans are and what the needs of those plans are in the budget, because those plans have to be funded. And that funding takes place in the joint board responsibility of budgeting. So that's the purpose of this language, is to clarify that the JOG-C's responsibility is limited to budgeting, taking into account the separate plans of each board, but not changing those plans, just simply funding the plans as the boards have approved them.
Right. Yeah.
Okay, I understand, and it's identified here on the bottom of page 4, 7.1, the paragraph, the JOG-C will take into account but will not reconsider actions taken by the board within their areas of separate jurisdiction as reflected in their individual strategic plans. But then if you can elaborate on the bottom of, bear with me, please. At the top of page 6, starting with respect to the planning and budget issues for the JOG-C approval, the process will govern how the organization will implement the respective strategic plans in the end. And then it goes further to say, once approved, the process will remain in effect until reviewed and modified by the JOG-C and staff with a mandatory review every 6 years. Can you elaborate on that? It's confusing to me. My understanding, the JOG-C does not modify.
That's the charter, isn't it?
The JOG-C
makes recommendations. It makes recommendations to the boards. It's a creature of both boards, so it makes recommendations to the boards. That's correct. But that sentence, once approved, the process will remain in effect until reviewed and modified by the JOG-C. Is it referring to the? And bear with me. I'm sorry. I meant to discuss this, but there's
I think this is in reference to the JOG-C's process.
Okay. Thank you. That clarifies it. Sorry.
Okay. No, got to be clear on what you're voting on.
Yes.
We're all clearer too now, so that's good. All right, do we have a motion?
So move. I'll second.
Thank you.
Okay, Ms. Ginsburg,
Yes.
Mr. Santos.
Aye.
Mr. Green,
Aye.
Mr. Jones,
Aye.
Mrs. Jones.
Aye.
Mr. Rue,
Aye.
and Chair Sanchez.
Aye.
Okay, the motion passes unanimously.
Okay, so that concludes our consent items. So we have one report followed by executive session. So we'll have Mr. Perez, Mr. Johnson, Mr. Kim, we have a whole bunch of people coming to the panel.
Good afternoon, Chair Sanchez and trustees. We're mindful of everyone's time, so we'll try to keep this short. For this presentation, we will cover 3 areas of the total fund. I'll walk through the risk section, Sanaya will highlight fund performance, and Dale will discuss the ESG and climate profile. As we start the risk section, please keep in mind that these slides may look different from prior quarters. Our portfolio analytics team wanted to provide a visual, high-level summary of risk metrics that we believe would be meaningful to the board. Next slide, please. One more. Thank you. We separated this slide into realized and forecasted risk metrics based on feedback from the team. As you can see in the top left-hand corner, as of fiscal year end 2023, if you can go back one, please. LACERA's total fund had a market value of approximately $73.5 billion and a one-year realized return of 6.4%. The one-year realized risk was 8.7%. Value at risk, or VAR, is a metric used to quantify in dollar or percentage terms an estimate of the maximum possible loss that a portfolio could occur over a given period. With 95% confidence, we do not expect LACERA to lose more than $15.5 billion or 21% of the portfolio in 1 year. Value at risk presents the worst case scenario because it focuses on extreme losses at the tail end of a distribution. Although a large loss of this magnitude is unlikely to happen, it is meant to be informative and something to be aware of when making capital allocation decisions. If we move to the graphs on the right, the top 3 dials show the number of manager relationships classified by active, private, and US-based funds. The bottom 3 dials show the dollar allocations as of fiscal year end 2023. The residuals are passive to active funds, public to private funds, and international to US-based funds. We will now focus our attention on the bottom half of the slide, which show projected risks. We cannot bucket projected risks with realized risks because it's not an apples-to-apples comparison. MSCI's projected risk numbers are based on a universe of factors using a multi-asset class factor model, which we explain in detail later. MSCI has a forecast risk for the total fund of 12.9%. This is an absolute number irrespective of the benchmark. The donut chart to the right shows how the 12.9% is split between the 5 functional categories. You can see that most of the risk is coming from growth and real assets and inflation hedges. The bar chart further to the right shows LACERA's current asset allocation compared to total fund risks. You can see the benefits of diversification because credit and risk mitigating strategies account for almost 30% of the total fund, while only contributing 5% to risk. Next slide, please. On this slide, we show MSCI's methodology for arriving at their forecasted risk numbers. By focusing on underlying risk factors, we can better understand total portfolio risks and build a portfolio that is more diversified across all common factors. If you take a look at the top bar, you can see that MSCI has a total risk broken down by currency and local market risks. If you go down one node, you can see that local market is further broken down by idiosyncratic or asset-specific risks and common factor risks. Common factor risk is modeled similarly to our functional categories. By no means is this an exhaustive list, but it does highlight the main risk factors within each asset class. The pie chart on the bottom left shows how risks are distributed across the total fund. You'll see that LACERA is fairly diversified and has exposure across most common factors. If you look further to the right, the bar chart shows total risks broken down by risk factors for each functional category. Not surprisingly, global equity factors make up a large part of growth, and global equity and private real estate make up a large part of real assets and inflation hedges. Next slide, please.
Can I ask a question of this?
Sure.
So for the future trustee who's not here right now, I guess. How do we take into consideration geopolitical risk?
Geopolitical risk within the MSCI risk factors, I would say it would be part of, if you can go back one slide, please. I think for like strategic asset allocation, it would be the top 2 layers. So that would be where it broke down by local market risk and currency risk and idiosyncratic and common factor risk. So I think like geopolitical would be, it's like market risk that would be accounted for within like at a high level. And then common factor risk, that's more of like, I would say like tactical asset allocation or tactical asset positioning. So that would be like further down, but I think it is accounted for in the MSCI factor model.
Yeah, and I'll support that. So geopolitical risk will express itself either through credit spreads at the sovereign level, through currencies, or
Wait for Nicole to come so you can tell her that.
okay, but sometimes it can be idiosyncratic, like you don't plan on a war. Go ahead.
So on this slide here, we look at active risks, which is comprised of selection risks and allocation risks. You can see that allocation risk is low because one of our investment beliefs is that long-term strategic asset allocation is a primary determinant of risk-return outcomes. Because selection risk is a large component of active risk, the investment team is actively monitoring managers and making recommendations to the board. LACERA has an active risk of 1.18 basis points, which aligns with other asset owners. Total fund active risks for asset owners usually range from 1 to 1.5 basis points, and MSCI is basing this on 6 to 7 asset owners in the US. If active risk is lower than 1, it may mean we're not taking enough risks, and if active risk is higher than 2, then it may suggest that we're taking too much risk. If we move to the bottom bar chart, this shows the portfolio allocation by region. You can see that we have a domestic bias with a substantial weight in North America. Next slide, please. On this slide, you can see that LACERA's portfolio closely aligns with the target policy allocation with very little over or underweights. With that, let me now hand it over to Sanaya, who will cover LACERA's fund performance.
Thank you, Catherine. Good afternoon, Chair Sanchez and trustees. Before we delve into the results for the total fund, we wanted to first show the board a snapshot of the overall market for the quarter. Here you'll see different indices based on the type of market they represent, grouped by LACERA's functional categories. The key takeaway I'd like to highlight is that you can see at the top both equity markets and fixed income markets experienced positive absolute returns for the majority of the quarter and 1 year, whereas our other categories, which are comprised of commodities, inflation hedging, and risk mitigating investments such as our hedge funds were relatively muted, if not slightly positive or negative. And in the following slides, as we present on our numbers, we should expect these key themes to play out in the performance results to reflect this market environment. Next slide, please. Here we'll start with providing key commentary about LACERA's performance. For the quarter, the total fund returned 2.2% on a net of fees basis versus its policy benchmark at 2.8%, underperforming by 60 basis points. However, for LACERA's fiscal year period, we have outperformed by 150 basis points. This is evident in our peer ranking table, which indicates that at longer period, we are doing well at our functional category level. And while at the quarter level, we did underperform, ranking at 81st percentile compared to a 60-40 portfolio or a 100% equity index. Over more extended periods, our performance proves that it's diversification and strategic asset allocation that are the primary drivers of returns at that. We are outperforming these hypothetical portfolios or even a full equity index and ranking close to the top quartile. Next slide, please. And as a reminder, for the quarter, the total fund returned 2.2%. This is a detailed view of how each functional category contributed to that 2.2%. As discussed in prior slide, on market environment with equity markets exhibiting positive returns, you'll see here as well that our top contributors came from our equity managers. And as expected, our biggest return contributor was State Street Global Advisors, which is the biggest equity account in the total fund. It's important to note that this analysis focuses solely on absolute return perspective, meaning it does not incorporate how the functional categories did relative to their policy benchmarks, and only evaluates whether each functional asset category generated a positive or a negative return that either contributed or negatively detracted from the total fund's performance. Next slide, please. Could you please turn to the next slide? Thank you. While on the previous slide, we've covered absolute return analysis, here we show the relative return attribution analysis, where you'll see our returns relative to their respective policy benchmarks. The total fund for the quarter produced negative 62 basis points in total value add. The primary driver of that of those negative 62 basis points is within growth. And within growth, the biggest effect was selection effect due to valuation and timing differences in private markets. You shouldn't expect to see any sizable or material effects coming from our allocation because, as mentioned in the risk section earlier, in our performance summary section, we are on top of our target weights. Therefore, as you'll see here, the allocation effect is very marginal, if not flat at best. And with that, I'll hand it off to Dale now.
Thank you, Sanaya. Good afternoon, Chair and trustees. This slide provides a snapshot of our approach to assessing ESG factors and climate exposures and the high-level metrics utilized in evaluating LACERA's ESG and climate profile. As trustees are aware, we've been using third-party ESG and climate data analytics to monitor public market managers and LACERA's portfolio on certain ESG profiles where the data is available. The charts in the middle of the slide are an example of how we are using the data where available, again, to gain insight into the ESG and climate profiles of portfolios relative to their benchmarks and amongst similar mandates. This analysis provides two primary insights. First, we can identify concentrated risks, areas of exposure and potential risks, and opportunities in the portfolio at various levels, such as the functional asset class or individual portfolios for assessing the fund's overall ESG and climate profile. Second, the data and analytics provide a quantitative profile of our external managers' approach to integrating ESG and climate factors in their investment process. This supplements our qualitative assessments of how managers are identifying and integrating ESG factors, which is presented in the ESG score of the manager scorecard, which is included in your quarterly performance book. This analysis provides discussion points with our managers to understand that how they are integrating climate-related analysis into the portfolio construction process. Currently, we can evaluate the climate profile of our public markets investments and real estate portfolio and engage managers on how they are taking into consideration certain ESG factors as part of their portfolio construction. We are pursuing several approaches to expand our coverage of the climate data for private markets assets, including modeling and tools such as the Global Real Estate Sustainability Benchmark and our currently in progress Private Markets Analytics RFP to provide a more comprehensive total fund view of climate-related risks and opportunities. That concludes our presentation. We're happy to take any questions.
Okay. Do we have any questions on this?
For a point of information, the peer comparison, independent of fees, how much does that change it with the fee structure in play? Or is that not available?
Yeah, so the peer ranking table in the performance book comes from our custodian. They collect data from their clients that also use State Street. Because of the different fee structures that are negotiated, we feel it's, for our purposes, our review, it may be a better kind of assessment to assess it on a gross basis across all of our custodians' clients. And so that table is what it represents. But I would say too, from comparing that to Makita's report, which, from our perspective, our reporting landscape is on net, we haven't seen any kind of big differences. Yeah.
Okay, Ms. Jones.
I was just curious to see, because I know we learned through history, right? Some of these categories we didn't even have years ago. But on page 9, where you do the contribution, which is actually a graph I really understand. I'm like, ooh, I understand this one. I was curious to see what this would look like comparatively for the whole fiscal year versus just the quarter to date. Is that something that's easy to do, or is it more difficult? I was just curious.
Yeah, we can definitely provide that to you.
Awesome. I just like to compare because, we look at the whole year sometimes to see, because this is also, so, just to get the sense of the full year versus just that quarter.
Absolutely.
We didn't do as well the quarter as we did for the year.
Okay. Any other questions? Okay. All right. Thank you. All right. So with that, do we have any other requests to pull any of the information only items? Items for staff review.
So I have the item for future agenda.
Item for future agenda.
Trustee Patrick Jones requested more cookies next month. I'm kidding.
No.
Requested that we agendize the hiring process for new positions and salary limits.
Yes, I was going to say something, wanted to say something, but it probably be public session. So
Yeah, yeah. Okay, great. All right. Oh,
On the STAR one, they weren't asking for anything. Oh, okay. I don't know why I remember that the STAR program.
The
where
STAR
they just-
COLA program.
Yeah, were they just letting us know that we're moving forward? It seemed like there was a question about whether we should approve it or not.
That's for the BOR.
Yeah, it said that the
It's for information only. Yeah, it's for information only to us.
I saw that, but when I was reading it, it said the BOR had approved it, so.
So it is for the Board of Retirement to approve benefits,
Right.
additional benefits. There's two parts to the process. The first part is the reading of the costs. We have to reveal the cost to the public, and then we come back next month, essentially asking the Board of Retirement to approve the benefit, and also whether it's an ad hoc benefit, a one-time, or whether it's a lifetime permanent benefit.
Gotcha.
So next month, we'll go to the BOR and ask them to approve that.
Gotcha. Okay, thank you, thank you.
Well, there you go. Okay. It's just so hard for me to say COLA. All right, on to good of the order.
Mr. Green.
Well, I learned yesterday I'm to report on my conference, CII. Thank you, Mr. Santos, for that. Before I get into that, just well done. I mean, I know that and not having to cross a picket line is duly noted and really appreciated. But to staff and the board and everybody that made this offsite happen, it's been really a great learning experience and a lot of information. And I just I can't say it enough to all the managers and your staff. I know you guys are the tip of the figurehead up here, but I know there's 100 people holding you up behind you. So to all those people and just ensure that they're all acknowledged in their efforts. And so thanks. It was great. I really enjoyed it. And CII report, I didn't get all the classes that I wanted, but I did have a very fun and interesting trustee dinner. Our table was the serious table, and table 2, which another trustee was there. I won't mention their name, but that was the horseplay table. But, I think we carried the load on that one for the fielding the questions and the relationship and getting a better understanding of what CII. I think it was very good that I went, and I'd like to attend in the future. I think there's a lot of stuff to be learned. I think that what their function is from my understanding, it's important. So they're really paying attention to some of the stuff that we're involved with. So that being said, that's it. Thank you.
Thank you, Mr. Jones.
Just another compliment to John Santos and the staff, the adaptability and the just the kind of esprit de corps, associated with this. Makes it enjoyable as a, we talk about uncompensated risk, but as a uncompensated trustee, that at best times it's nice to come in and have a very positive affirmative work environment and do our role for the public as such. That's all I got.
Thank you, Mr. Ruth.
Thank you. I thought it was a great retreat. Learned a lot. I mean, there's still a lot more to learn. Really thank the staff for all of your support and being super responsive, both on the administrative and the investment side. And a lot more to do. The monthly meetings come by so quickly. Every month I'm like, oh, I got to follow up with this, follow up with that. And then next thing I know, it's the next board meeting already. So, I'm a little still shy of a year, but it's becoming more and more familiar. So thank you to the team.
Thank you. Mrs. Jones?
Thank you. I just wanted to echo what everyone else has shared about the effort and the hard work. I was looking at the agenda for today and going, man, on top of doing all the material you had to do for the on-site, off-site, you still had to put the regular material together for our, our meeting. So kudos, hats off. I was really impressed with our speaker yesterday from BlackRock. You guys never seem to fail when it comes to bringing in some really key speakers that we can really learn from and get an outside view, outside of the LACERA wall. So I do appreciate that effort. And I know that that's no small feat to reach out to these agencies and, pull them and say, we need you and come and speak with, with the board. I also appreciated the information discussed today under risk management to give not just us more comfort in the process that goes on behind the scenes, but also for those that are listening in to hear the steps that are, that are taken meticulously for each investment and to review those investments on an ongoing basis. So I did appreciate that conversation. The only thing that I also wanted to maybe suggest is the information on the history of the evolution of what has occurred over the years for LACERA and what are, even the thing of the financials from 1936 to now. Is there some way that that can be placed not just in our packet online, but somewhere else online that just says, hey, here's a little historical view of the investment side, so that it can be available, because it is so well, it's important as a retiree to see this, because you have comfort, as Trustee Santos said, I want to, retire and feel comfortable that things are, that check's coming in the mail. But also from management and also outside companies that are looking to do business with the LACERA, to see that evolution, I think would be really nice to have that available, not just somewhere in a packet where you got to keep clicking to get to it. So just a thought.
Great idea.
But other than that, again, great conference. I learned a lot, took a lot of notes, and I don't know how you guys are going to top it next year, but a great job.
Thank you, Ms. Ginsburg.
Thank you. I want to echo everybody's comments this far. It was an excellent educational experience for me. I don't get to come to a lot of these meetings, so a lot of it was very easy to understand. The materials that you put together, I know, took a lot of effort, and it was really helpful for me to hear the presenters and listen to the questions asked. So I really appreciate that. So I'll be taking that back. And I also appreciate the staff's responsiveness to some of my follow-up questions on some of the materials that I've reviewed, but really educational. I really appreciate it. Thank you.
Thank you. Ms. Gray.
I actually echo everyone else's comments. One thing I have to say is, and this is what I like, all the materials that staff presented to us, I always say, talk to me like I'm a 6-year-old. And that's what happened. And I was so happy to understand and read everything. More importantly, I have to say, I want to give kudos to this particular board. And I really, really am happy to see that you literally read the information. It's like Mr. Santos had said, oh, people are just, opening up the envelope and reading stuff. Well, this time I see everybody cracking that binder to see what's going on and asking questions. And though I said earlier that, through the evolution of the board, Mr. Santos is actually, giving the CIO the ability to make investments. He's not delegating his authority, believe me. This board, you still have to come back to the board. However, that trust that has evolved that I've seen, I think is just fantastic. But it's also staff. You put so much work into it. Our consultants, although you're paid to do it, but you really take care of us, and I appreciate that. It's not just from being on the Board of Investments, but it trickles down to the Board of Retirement. That's why we have Mr. Kryman sitting here. It assists the whole administration. It is such a well-working wheel that we actually roll down and roll up the mountain, because really we are the big dogs in California. So thank you so much.
Thank you. Mr. Santos.
Yes, thank you. I also want to echo what my colleagues have said about the level of work that the staff performs on a regular basis. It is, I have to say that for me, this was the best Offsite, inside, whatever you want to call it, program. And going through the investment process that started actually the last board meeting in terms of the investment committees and stuff like that. Talking about my colleague, Ms. Gray, to see my evolution. And that didn't come lightly. It was earned by every single one of you staff under the leadership of Mr. Grable. The level of confidence that I have, having been here with, I think it's 3 prior CIOs, and the level or the high level that the staff operate today, it really gives me comfort. And it's something that's important because it's very difficult to make a change in the philosophy, in my philosophy, when I came in, because I came in with a mandate that I was to be suspicious of every single person here handling the money, and that I was required to come in and make all the decisions. And it's humbling to understand what you don't know. See, a lot of times we don't know what we don't know. And over the years, I have come to respect and admire your level of competency that you have demonstrated day in and day out. It is the members of LA County should be very grateful for the level of work that you do, because I am really proud of all the work that you have done. So the evolution is not, it was not just overnight. It took years in watching every single one of you on how you operate, how you behave. And what's important is that every time we go to a conference, there's always somebody coming up to you and saying, I'm working with so-and-so from your staff. I mean, some of you are so well known in the industry. And that to me is really important, because we're up there. You are up there, day in and day out, dealing with all these different opportunities come your way. But I think Mr. Fernandez said it was like a funnel of all these opportunities, but only 1 or 2 of those opportunities is deemed to be appropriate for us. That is tremendous. And so I again thank you from the bottom of my heart as a beneficiary, and for making my job as a representative of all the county employees that put me in this position time and time again for the past 20 years. But it's not me, it's you. You who has given me that opportunity to go around and brag of how well we do. And when we go to different conferences and we talk to other trustees from other pension funds, it is just so wonderful to be able to walk away and say, we're doing something right, and we are better than you, privately. Yeah. It's something that I could not say in particular with regards to the real estate portfolio for many, many years. You have heard me say that. But that changed, and we are in a process, again, moving the big old ship in the right direction which is important because we need all our asset classes to perform, right, in order to be able to minimize the employer contribution. And that is huge. Now, I just wish that the Board of Supervisors understand the work that we do here, because we need to make sure that we continue to figure out ways to retain you and hire those people that should be the top in the industry. But we're not going to be able to do that unless we are able to pay people what you deserve. And that's why I know many of you have thanked me for advocating for you. It's not because I'm a nice guy or you have been a nice individual with me. It's because I have seen your work. And I know that every time I stand here and say we need to support the staff, we need to make sure that we are competitive. That's because of the respect that I have for you and the work that you have done. It's really empowering. So thank you very much. And Mr. Grable, thank you. Appreciate it.
Chad.
My turn? Thank you very much for all the kind words. I'm basically a conduit or sieve because everything, goes to everyone, that's across the hall behind me, maybe downstairs eating now, but a huge shout out to the investment team for all the hard work that went into this offsite, as well as the board meeting, towards Mrs. Jones' point that, we had that as kind of a side gig this month. And thank you once again to all the trustees for making this productive from everyone's perspective. I will do a little bit of a shameless plug here in that today the PRI, the UN PRI, announced the candidates for, there are 3 vacancies, asset owner vacancies on their board. There are 5 candidates, 1 from Australia, 1 from Italy, 1 from Denmark, 2 from the United States. 1 of those from the United States is me. So shamelessly, I'm asking for LACERA's support on that ballot when we vote it. And whoever's listening, if anyone else is listening, I encourage all asset owners to vote for Jonathan Grable. There is a statement and a video on the UN and the PRI's website, and my statement and video and desire and interest are earnest. So hopefully I can have their support. So thank you for giving me the mic here to plug myself. But I think part of this in seriousness relates to LACERA in terms of how we're evolving as an organization. And I think that this is, a part of that maturation. So thank you.
Thank you, John. Santos?
Wow. I can't imagine Mr. Grable becoming an elected as opposed to an appointed individual. But I did want to say that I wanted to recognize my my administrative staff, my support staff that put in a lot of hard work. I know that that our IT folks have been working extremely hard to make sure that things are running properly and that we can hear each other. Linda, you did a wonderful job coordinating everything. So you continue to amaze me, quite frankly, and you and Bonnie are a dynamic duo, quite frankly. I did want to congratulate the investment team as well for putting on a wonderful offsite, onsite, and pivoting as quickly as they had to in order to make this happen. And then the last thing that I did want to do, I did want to recognize Mr. Grable for his leadership over the last 5 years, 6 years. He's on 6 years now.
6.
I think it's important to point out that his leadership is invaluable, and I learned that he's a team player in terms of him being willing to do what is in the best interest of LACERA as a whole organization. When we were going through the pandemic, I had to rely on him to do a lot of operational things that he and his team took hold of in terms of the cash management and settling transactions and things like that at a remote location. And so I also lean on him to be a sounding board, in terms of HR issues or policies and procedures, and what do you think about this? And so he's been invaluable in that particular area as well. But I think that his most value has been his ability to construct a durable organization, a resilient organization that really keep their eye on the ball. Quite frankly, he's managed to do all the things that leaders need to do, which is hire good people, train them, empower them to make decisions on behalf of whatever the mission is and whatever the vision is. And he's done that, and he's executed, quite frankly, above and beyond in terms of what your expectations are moving from allocator to investor. And that is definitely, I'm a firm believer that everything rises and falls with leadership. And the board's leadership was invaluable. The day-to-day, like I said, the expectations, we know what your expectations are. They're very high. And Mr. Grable has managed to establish a standard that, quite frankly, is going to be, we're going to look to try to establish it even higher. Maybe he's an exceptional. We're going to try to get to elite now. But that's something that we're going to be working together on. And so as a beneficiary myself, I don't sleep real well at night, but as soon as I get to retirement age, I think I'll sleep a lot better knowing that the investment team and the board is moving in the right direction. And so I just wanted to say thank you for everything that you've done and will continue to do, quite frankly. So thank you.
Thank you, Santos.
Okay, so we are in our love fest right now. I will begin by saying thank you to John and your team, but I'd like to focus on you, Mr. Grable. You set a high bar, and you set a high bar through your action, and it affects your team in the most positive way possible. And so I think that is, and I think the evolution that we've experienced over the last 6 years is a result of that, sort of willing to pull up your shirt sleeves and do what it takes, grow your team, get the right resources, move in the right direction. It shows, and I want to acknowledge that. It is impressive. From my perspective, I want to also thank and congratulate the board, the members of the board. We had, I think, one of the most interactive and engaged dialogues on some pretty tough topics. And I want to say that I'm not only wanting to give a shout out for the fact that you were engaged, but the fact that the opinions were not all the same. We were able to differ. We were able to listen to one another and change our minds. And I think that is the sign of a working and functioning board. You will never have 100% agreement, but hopefully you will have 100% agreement on what we're trying to do. And that was very evident over the last 2 days, is that we all agree on who our beneficiaries are, what our mission is, and how, and we just have to figure out how to accomplish that. And so I want to say that this has been very enjoyable for me from the position as a chair, because I cannot do it without all of your help and your support and your attention and your everything that goes with that. So thank you. And I just want to say that we have gotten to a phase in the organization where we have grown, we have matured, we have made commitments to learning, commitments to professionalization. And I think our next phase is to figure out how to institutionalize that so it becomes irrespective. So we keep that bar permanent. We keep that high bar permanent. And in that regard, I want to, give a wholehearted welcome to the newest the elected members, Nicole Mai, who's here, and Debbie Miller, who's at home. I am Debbie Martin, who's at home. And I am I have only the highest expectations because the willingness to come and listen, and this is like drinking from a fire hose. But the next phase, like I said, is to take all the hard work and the lessons learned and to turn it into well-designed policy that can withstand any board and any CIO. So take that high bar and make it very difficult to lower it again. That is our goal. So, not a small aspiration here. I only make them big as I walk out the door. But I really appreciate that we are in a position to be able to have that conversation. So thank you. So with that, I will excuse everyone who will not be in executive session. I think we'll need about 5 minutes to reset. And so please have lunch. You will not hear us because you can't. Haha. Thank you. Yes.
The sequence,
Yes.
is it the
recommendation and then the two legal?